pull the camera back and think long term.
If we do go into a recession, it will be a mild one.
Consumers still seem to be spending. The labor market still seems to be strong.
You could have goods deflation this year. That is a very different story to last year when US inflation was accelerating.
We're getting more confidence, especially for the large banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I told you, you drink at the airport, you miss flights.
You miss flights. I missed the damn flight. I'm sorry.
Live from New York City this morning.
New York.
Good morning for our audience worldwide. Alongside Tom Keene, I'm Jonathan Ferro. This is Bloomberg Surveillance. Equity futures right now on the S&P down 0.25%. TK, what a difference a rally makes. 4-day winning streak on the S&P. And all of a sudden, the 2023 consensus shatters.
It's all going to be, I was really thinking about this seriously today, John. You and I have an envious ability. We can really not have an opinion. People are paid to have opinions, and they're recalibrating the opinion right now. The zeitgeist over the weekend was more in the bond market, price up, yield down, bonds doing better. But again, equities with a VIX of 20.07 have been better than good.
I tell you, Mike Wilson of Morgan Stanley is not changing his opinion. Let's bring up the quote from Mike this morning, him and the team publishing a little bit earlier on. Bear markets are like a hall of mirrors designed to confuse investors and take their money. He went on to say, trust your fundamental process. For us, margins, earnings, Tom, are likely to significantly disappoint whether there is a recession or not. That's Mike Wilson of Morgan Stanley this morning.
We're looking at margins and earnings here. What do we have at 7:30, John? Goldman Sachs?
And
That's
Morgan Stanley
be interesting.
too, yeah.
I mean, they've got, Shanali had the recalibration of what they're doing in their consumer product area with layoffs and such. And then Morgan Stanley, perhaps a victory lap there as they continue to consolidate Eaton Vance and E-Trade.
Looking to wrap up earnings on Wall Street a little bit later this morning. Good morning to you. Let's wrap up the markets for you. Equity futures, as I say, just a little softer on the S&P. No real drama, though. 4-day winning streak on the S&P. Believe it or not, the longest daily winning streak going back to
above
September
4,000
last year. Will we snap that winning streak today? In the bond market, yields just a little bit higher by 4 basis points on a 10-year, 354.76 on a US 10-year yield this morning. Tom, I was going through the numbers out of Europe. Euro Stoxx 50 year to date, up 9.6%. EM equities year to date up 7.8%. And if you want to pick a single name this morning, let's take LVMH. LVMH is up more than 16%. Year to date so far. What have we had? 9 trading days.
Some of that's a Euro play, but we got a number of things going on here as we were sat, particularly with Francine and the team at the meetings of the World Economic Forum. And John, what I would focus here on the reset is everything is overwhelmed by the presumed China opening, and against that, the challenges of Japan. Those are the backstories, and our lead guest here to get us started on Monday will help us with that a lot.
Al Salinas, Global Head of FX Strategy at RBC, joins us right now. Al, so we'll talk about the BOJ in just a moment. I think investors not interested in good versus bad, but better versus worse. Are things getting better or worse?
So it feels like you've got conflicting signals coming at the moment, a muddled outlook for many, in that if you look at the equity market, as you highlighted at the start, huge rallies to start the year, some real optimism airing in. At the same time, yields moving lower, so bonds rallying. It's that kind of bond equity rally that's the perfect storm for the US dollar. But it does feel like there's a bit of a conflict between the messages we're getting from the two sides.
Do you think that move we've seen in the dollar so far is sustainable? Are there some sustainable headwinds against the US dollar that you think last through 2023? We've had a 10% plus move since the end of September, Al, so that's quite a move.
Exactly, and I think the danger is we're falling into the same traps that markets fell into at the start of 22 and at the start of 21, where everybody starts the year with a very strongly bearish dollar consensus. I know it feels weird given how strong the dollar was in 22, but that was the consensus at the start of the year. And we spend all of January putting on those positions, and then it snaps back. Whether it snaps back in February, March, whether this year takes a little bit longer, maybe in the back half of the year, it's not going to be quite as straightforward as just sell dollars and close your eyes.
Elsa, Lisa Abramowicz in the last hour with Kenneth Rogoff at Davos and the World Economic Forum, and they're talking there about the Fed and about this relentless rate increase. Against that is the distraction of Japan. I thought Ambrose Evans Pritchard in the Telegraph with Professor Rogoff today with a nod to Olivier Blanchard was just brilliant. The giant wild card, Japanese inflation, has returned in the aftermath of COVID, pushing the country from a bad but stable equilibrium into an unstable equilibrium. And just for perspective, folks, Japan owns 8% of France's public debt. Elsa, how do you synthesize the Japanese conundrum?
This is a really interesting point, Tom, because we've actually started to see it in the data coming out from Japan. They have turned into sellers of European government debt. And as you highlight, they are big holders of French government bonds. My colleague Adam Cole has done a lot of fantastic work on this. And though they've been selling treasuries in large size for a while, the last few months have been notable in that we've seen EGBs take the lead. Why is that happening?
Right.
Well, it's the cost of hedging. It's euro-yen and the cost of hedging that exposure.
What you do on this, and AEP has a wonderful chart on this, is you take the yen swap yield versus the published yield, the one folks that John Ferro follows so closely. And there's a huge gap. Where does dollar yen go on that presumed gap? Can you get to 120, or dare I say an even stronger yen down to parity?
So I'd actually look at it the other way and say, unless the Fed is going to be cutting rates dramatically in 2023, and we're not talking one or two cuts, but really slashing rates, under most other scenarios, the cost of hedging continues to rise for Japanese investors. They're actually going to have to reduce those hedge ratios. Dollar yen goes higher. I know that's not a popular thing to say, but that could be what we see for the balance of the year as a whole.
So can we talk about the BOJ this week? There is massive speculation. They're going to adjust yield curve control, maybe drop it altogether, adjust the band, move the maturity they focus on. What are you focused on?
So it's the combination of factors, right? It's yield curve control coupled with the inflation forecast. A lot of speculation that Kuroda's going to want to leave a clean slate for the next incoming Bank of Japan governor in April. It may not happen today. Actually, I think most analysts expect it to happen in March. But as you said, a huge amount of speculation. We've actually gone long Swiss yen into this meeting, only because we might be getting a bit ahead of ourselves in terms of how much we're expecting for tonight.
So that's long Swissy against the Japanese yen, looking for a weaker Japanese yen here, Alsa.
That's right.
Alsa with a call there, Tom. Long Swissy against the Japanese yen.
This is
expecting the JGB, or rather the BOJ, to disappoint a little bit.
And this is important, folks, in that you don't look at just dollar against a pair. There's other cross rates as well. Elsa, what do you do on the Pacific Rim? If we have an opening up, John mentions Europe on a relative basis off the mat doing better. But as a Pacific Rim play, what does RBC Capital Markets look for? What's the best pair?
So we've been looking at a number of pairs. The Australian dollar, we don't typically love it, but actually there have been good opportunities. We were long Aussie against CAD last week, and it's something we'll look to revisit on and off as the year goes on. There has been a lot of speculation, a lot of positioning around China reopening, but that may have a little bit further to run. And not just the reopening, but also apparent thawing in relations between Australia and China that I think is worth paying close attention to.
You know, I look, Elsa, at the moment, as John mentions, it's a Bank of Japan week. Everybody's radar is off Europe. What are the degrees of freedom that Christine Lagarde has right now? She's the least talked about, I would suggest, right now, and all my radar's up on that.
Yeah, she's probably happy to be out of the spotlight for a bit, right? But there was a really interesting interview this morning given by Philip Lane, the chief European economist, and he was highlighting that rates still have to rise further, but that Europe is facing a shock in terms of energy prices that the US is not facing. And that at the end of the day, that does mean rates will have to rise less in Europe than they have risen in the US. I think that's an important reminder to just, there are critical differences between here and the other side of the Atlantic.
I look at, Elsa, the moment in foreign exchange, and it is about a certain weak dollar. What is the level of weak dollar? I think it's so important to reset going into the end of March into April. How much is the weak dollar move going to be?
Look, I think in terms of the year as a whole, I actually expect, and again, I know this is going to sound controversial, I actually expect the dollar to end a little bit stronger, certainly across the yen and probably against the euro as well, just given where we are now. How far we overextend into the end of March is really anybody's guess, because I do think that momentum for the weak dollar trade has some more legs, has further to run. But again, as I said, I would be looking for that as an opportunity to reposition for a slightly stronger dollar in the back half of the year.
Just the final one from me. What's the number one factor behind that dollar strength that you anticipate in the back half of 23?
Combination of the Fed potentially not easing as much as people anticipate, coupled with the fact that, as you said earlier, we've had a 10% move since September. We've priced a lot of that story in already.
An amazing turn we've seen in a couple of weeks. 9 trading days, Alsa, and all of a sudden a lot of people changing their minds. Alsa Linos of RBC. We talk about the South Side a lot, Tom, setting the consensus, shaping a consensus. The South Side doesn't shape the consensus. The price action does. The price action of the last couple of weeks has shaken everyone up.
we have to be very careful here about, tar and feathering people that got it wrong or, giving somebody a victory lap this early in the year. The fact is the uncertainty is because of the pandemic, the opening in China, still the supply side dynamics that are unknown and original. Nobody's ever really faced this, John, bouncing over to conventional central bank and interest rate theory. And you bet that in the foreign exchange market. That's the deepest market. It's the biggest market. It's the easiest place to make bets.
As you know, Tom, and we mentioned this a little bit earlier this morning, investors aren't preoccupied with good versus bad. It's better versus worse. And I think capturing that perfectly is the view of Deutsche Bank going into the weekend on the German economy. They wrote this on the German economy.
I missed that.
We now expect annual GDP growth to stagnate in 2023. That's not great, is it? But the fact of the matter is it's better than they anticipated a few months ago because they're no longer looking for a recession. Now, that's the argument. That's the argument you face right now. Things are arguably better now than they were 3 months ago. Do you expect that to last the rest of the year? And the mistake you can make is take the first couple of weeks of trading of any given year, Tom, and then extrapolate that out through the next 12 months. This is going to be a bumpy ride.
It's a territory of Anne-Marie Horton and Maria Tadeo, but I would suggest coming up with recession depth and magnitude in Europe is very difficult when you have some form of missile that's supposed to take out aircraft carriers landing on residential buildings within Ukraine. And you overlay the war on this, and I have real trouble with anybody giving me certitude.
Euro-dollar right now, 108.24. Anne-Marie, AMH, down in Washington, D.C. in just a moment. Let's whip through the price action briefly and get you up to speed on what you're waking up to this Tuesday morning. Equity futures down about 11 points on the S&P. We're down a third of 1%. Coming into Tuesday, 4-day winning streak on the S&P. Will that stick? In the bond market, yields a little bit higher, up 4 basis points on a 10-year, 354.57. We wrap up bank earnings a little bit later this morning with Morgan Stanley and Goldman Sachs. And then we'll have a little look ahead as well to tech earnings a little bit later this week with Netflix, then on to Apple in early February, Tom.
Brent crude, $85, small matter. There
WTI,
it is, underreported,
approaching 80.
undervisible. Jeff Curry, I know, floating around within the zeitgeist this morning. Just this, just a little bit.
What is that? What is that?
Just nudging.
It's
sort of a nudging. It's just
okay.
On radio, it looks good.
I'm sure that really
Good morning
works.
on radio nationwide, I should say.
Good morning to you all. We can now head over to Switzerland, to the World Economic Forum, I'm pleased to say. Bloomberg's Francine Lacqua, speaking with Larry Fink, the BlackRock CEO, at the Bloomberg Year Ahead event.
I'll give you a major theme. Probably the big theme is hope. That is my word of the moment that I'm really using it. I'm using it here.
Hope for a better economy?
No, the whole concept of hope. COVID has really changed how we think. The fear of mortality was developing the world. The polarization, the politics, a war. If you look at birth rates in the world, they're collapsing in the developed world. I mean, you don't bring a child in the world unless you believe tomorrow is better than today. If you look at the savings rates in the world, the savings rates have mounted up dramatically in the world. BlackRock is a firm that tries to sell hope because why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? And more and more money has been held. In China alone, there is estimated $2.7 trillion of more savings in the system. It's in the savings rates in China are in the high 40s. People are not investing in the future. They don't have that, the safety nets of healthcare and retirement. And so we're losing hope. And the polarization of politics, which media source do I even believe in?
Bloomberg.
Okay, fine. You need to get that out. No, but Francine, more and more people are frightened of the realities of today, and that's manifesting in so many areas, and so that's going to be a major theme. And I talk about that a lot today.
If you look at hope, then it has to be backed up by a better world, a better economic situation, inflation going down. How do you see that progressing?
Well, that's when I talk about hope, I'm not talking about whether the markets are up or down in the next 12 months.
But standards of living.
Pardon me? But standard of living have to grow, obviously, wages, and we're seeing that. And people have to feel more comfortable. And I'm not just talking about a phenomenon in Western Europe or North America. I'm talking about the world. And And there's less hope in the world today.
Do you see the world, though, getting better, so economically?
Sure. Look last year was a year of transition in so many ways. I mean, obviously, the first time in 40 years, and this impacted BlackRock in our earnings that I reported on Friday, we had bond market down 13%, global equity markets down 18%, and then for us, the dollar appreciated dramatically. But if you were on a desert island for all of last year and you had a pool of money today, you have greater abilities to invest today than you did a year ago and 2 years ago. If you look at a normal retirement portfolio, and this is something that we don't spend enough time on, a typical retirement portfolio in around 2002-3, you could have owned 40 to 60% in bonds and earned your return of 7 7/8 and 8. Yep. By 2020, you could not own a bond. I mean, so you had to take so much illiquid risk. I mean, think about the growth in privates and private equity. Why? Because you could not make a return in bonds. Today, with you could get 4% in short-term treasury, you get 5% in credit, 8% in. Right. You could now go back and have I would say a better portfolio, a better asset allocation today than 3 years ago. You could reformulate it and bring down your illiquidity risk. And the question that we all have to ask as investors, do you believe we're going to have more liquidity in 5 years than we do now? I don't think so. I think we're not going to have the support of Federal Reserve for years to come, or central banks. We saw the limits of fiscal stimulus in the UK, and every other government is now facing that. And so the reality is we are going to have less liquidity, and it has to be market-based liquidity. So how much illiquidity do you want if you're running a retirement plan? So the big issue is bonds play a bigger role today than they did in the last 7, 8 years.
Where do you put your money in the next 12 months?
Look, I'm an optimist. I've had a portfolio in equities my whole life, or some form of equity-related assets. Even at my age, I'm not changing that view. So I don't allow markets like today. Getting back to PEs. PEs are more realistic today than they were 2 years ago. I could go on and on and on. We're spending so much time focusing on the tragedy or the recalibration of last year. But the reality is there are better valuations in companies today than there were 2 years ago. You can earn a better return in bonds than you did 2 years ago. And so we're festering on what happened last year and all the travails, and we're talking about, oh gosh, is inflation going to be, how fast is it going to fall? Let me be clear, inflation is falling. The question is, can it fall to a 2% rate, which I question it will. I don't even know why we have a 2% target. I've raised that question many times. Could inflation be brought down to 3.5? Absolutely. Now, does that mean the central banks are going to keep rates higher for longer? Maybe, and that's the issue that I have related to liquidity.
So you think
Larry Fink of BlackRock there, sitting down with Bloomberg's Francine Lacroix. You can continue watching the conversation on Live Go on the Bloomberg terminal if you are a subscriber. Tom Keene, alongside me, Jonathan Ferro, live from New York. This is Bloomberg Surveillance on TV and radio. Hope, TK. Have you got hope for a better future?
Well, it's hopium. I mean, that's what's out there. Lawrence Fink is different than most CEOs. He's been heavily vetted to be Secretary of Treasury at given times. He's certainly someone that's really led the charge on ESG, which at Davos is under great threat this year. With the return of King Coal, there'll be a new ESG presumed forward, given some form of end of the war in Ukraine, the future of Mr. Putin. But Larry's a guy that mixes a real prodigious fixed income ability, that's the foundation of his BlackRock, with a lot of conceptual stuff like what we heard there on Hope.
You get the feeling that a lot of these asset managers are taking the opportunity to attract some capital to their bond funds don't you think, coming into 2023, bit of a change?
Yeah, and what's interesting here, and this goes to the promenade folks, where, with 20 years there, you walk down and you see a changed promenade over the years. A promenade used to be a lot of buy-side houses, including or whatever it is, as well. And the answer here is in 2023, up Happy Valley, they're hoping for the return of active management. To the immense credit of Mr. Fink and others, they've been a little more indexy than others.
Back then it was called
Aberdeen. Are you
Aberdeen.
laughing at me?
No, I'm laughing because back then it was called Aberdeen, wasn't it?
It was back then. It was called Aberdeen.
Mr. Gilbert.
And to Mr. Fink's credit, he has been consistent that it is BlackRock with their better than good earnings that they showed.
They're not going to drop the vows over at that asset manager.
They're not going to go.
Okay.
Yeah, it's not going to happen.
Equities right now down about 1/3 on the S&P just to kick off the trading week. Equity futures negative 1/3 and down about 11 points. Yields a little bit higher, Tom, up 4 basis points. Your 10-year 354.57. You mentioned it a few times, Tom. Crude close to 80 on WTI, 79.97 this morning.
This is the quiet story of the year, and it's global recovery and what we see. You talk about hope, the hope of China extricating itself. Some of the death count of COVID in China, it's really...
And population decline as well. Do you see that headline this morning?
Yeah, and again, out of Davos here, a Chinese authority in full presence at Davos, they're confident China growth is most likely to return to normal. China will always promote all-round opening up. Hope from China. Right now, we hope you can put up with Anne-Marie Horton. She is Bloomberg Washington correspondent and joins us this morning. Just a general question. A beleaguered president who spends a lot of time at other houses and documents. How was the president's weekend, Anne-Marie? It seemed to be a little calmer than the previous weekends.
Well, yeah, that's right. He was in Atlanta giving a speech, of course, at the church that Martin Luther King Jr. was a pastor at. And this was him celebrating the life and legacy of Martin Luther King Jr. But of course, if he's eyeing a 2024 run, Georgia is going to be a really important and key battleground state. That's a must win for him. But then also he was out talking, and of course the debt ceiling came up and what the Republicans are doing, and he had called them fiscally demented. And this comes on the heels of Republicans, the representative from Kentucky, who's the chair of the Oversight Committee, asking the chief of staff, Ron Klain, to release the individuals, a log of who goes in and out of President Biden's home, which of course they do not do for personal residences of presidents. And the White House was quick to say that at least this administration, unlike the prior administration, releases logs of who sees the president at the White House in the West Wing.
What's the date calendar for our debt crisis that we have? I've been briefed by you and others that it's into autumn or late summer that we would see a debt crisis, and yet right now we seem very crisisy. What's the week's events or even into the end of January?
Well, it's crisisy at the moment, if that's even a word, because Secretary Yellen had said last week that she will have to start using special maneuvers to make sure we can pay our obligations starting this Thursday. So for me, that's the first ringing of the alarm for Congress to try to get in a room and figure out what they're going to do. But we do know, and Representative Gonzalez on Fox News on Sunday made this pretty clear, the debt ceiling is going to be a knife fight.
Let's not make that a word.
Were you laughing at me?
Yeah, I just don't think that's not a word, and I don't think we should make that a word.
If Lisa was here, this wouldn't happen.
You reckon? We're catching up with Lisa later this hour.
Yes, we are.
Look forward to
in
that.
Davos.
Very cool. Hey, mate, it's just a final one from me. Secretary Yellen's on her way to Switzerland, just not Davos, right? There's going to be a stop there on the way to somewhere else, and she's meeting with the Chinese. Why there? Why now? And what about?
Well, the Chinese Premier Liu He is going to also be at Davos, but they're going to be meeting. And honestly, this is going to be the more important meeting because everyone at Davos is going to want to know what comes out of her sit down with the Chinese premier in Zurich, less than 100 miles away from the Swiss mountain tops of Davos, where all these elites. They want to know what China trade, this relationship with the United States looks like going forward. It comes on the heels of Xi Jinping and Biden, of course, sitting down at the G20. And then it also comes ahead of we have Blinken very much expected to go to China at some point this year, early this year. So this is just about them talking a number of issues and follow-ons from Xi Jinping and Biden's meeting. But there are moments where this can be contentious, right? The U.S. and China do not have similar views when it comes to human rights, when it comes to trade, when it comes to Taiwan. So it'll be interesting what comes out of this. Also, Treasury Secretary Yellen had told Bloomberg in November that Xi Jinping's firmer grip on the government and some leaders leaving his government potentially may change the outlook for how China grows. So maybe this is also a fact-finding mission for her.
Well, let's start with tone and then go to policy. So the tone has shifted. Maybe it's a little bit softer based on what you've heard from several Chinese officials in the last couple of weeks. Does that tell you anything, Anne-Marie, about the trajectory for policy, the shifts we could expect, anticipate in the months, years ahead?
Well, I think this just is an opening of dialogue. But in terms of policy shifts, it's very hard to see that, especially when, tomorrow you have Yellen sitting down with China's premier. But at the same time, today you have the head of Netherlands, Rutte, going to be sitting down with President Biden in the Oval Office. And the U.S. is trying to convince the Netherlands to their gem, ASML, to not send advanced technology to China, which is a major player and one of their major customers. So this is what they also did last week with the Japanese. So at the same time, you have Yellen sitting down with the Chinese, and obviously trade is super important. These export controls is something China does not want to see. The United States is coalescing other allies to follow in their lead in terms of this policy.
Anne-Marie, thank you. AMH down in Washington, D.C. AMH will catch up with you in the next hour. Equities, Tom, a focus for many of you, I know, but right now I think foreign exchange for me and you. Dollar yen 128.92. And a focus on Japan a little bit later this week.
It's a mix of it. We've got like 20 pairs on my screen here under equities, bonds, currencies, commodities. You can look at all the different ones. Some of the EM ones unraveling due to idiosyncratic ideas. Some of them doing better. Mexican peso, I note 18.81. But I think it is a time to look at the majors and the mix. You mentioned Swiss yen earlier, and it also is the economic data. So you look at what we don't look at, which is yen, Japan, in their morning of the 19th, a day and a half from now, where they will see national CPI statistics. I see on the Bloomberg screen
and we get the forecast this week too.
4% number.
We get the forecast this week too from the BOJ.
Yeah. And all of my work on this, I've never envisioned, I've never thought about Japan with a 4% inflation statistic that turns upside down their domestic.
So much has changed coming into 23, and I think it started with the BOJ at the back end of
you need
22.
Hope. Mr. Fink says you need hope.
That sounded like a salesman, didn't he? We sell hope. We're in the business of selling hope. Dollar yen right now, 128.91. BOJ, a story for later this week.
Stay with us.
Let's get to the story right now. Bloomberg's David Weston, our good friend and colleague, speaking with Jane Fraser of Citi in Davos at the Bloomberg Year Ahead event.
And that translates into, Larry touched on a few of them, but it translates into energy security, it translates to food, water security, financial security these days, the list goes on. But we've seen it with supply chains, we've seen it with companies' operations. There is this new thinking much more about operational risk. And that's become a much more dominant part of globalization. And as we heard from Larry, I couldn't agree with him more. These trends are driving more complexity into globalization. Those complexity costs can all be managed, but they are expensive.
Complexity is one word for it. Another might be friction. There's more frictions from all those sources you identified. Does that inherently mean there's a drag on global growth, economic growth? And specifically, does it mean there's a drag on city growth?
No, we've seen extraordinary growth. So if we go back to what Citi is, we're essentially the bank of choice for clients who have cross-border needs. We operate in 100 countries around the world with a local bank, and we wake up in about 160 that we'll do business in. But our core clients are 5,000 multinationals, and we move $4 trillion of volume just for those 5,000 companies daily, in foreign exchange, in payments, in trade, and really everything that they need to operate their payrolls and their core supply chains and treasury businesses. That business last year grew its revenues for us by over 30%. I mean, the volumes have exploded as clients have moved around, supply chains have been reconfiguring, additional suppliers have been added in, folk have been looking beyond China to look at not necessarily a pivot away, but what is the additional areas of supply chains that say in India or Mexico, all parts of Asia have been benefiting from as well. So that shift in mix it has been adding growth opportunities, not taking it away, which is not always intuitive.
Those are very impressive numbers. How much of that is the overall size of the pie growing? That is to say, cross-border transactions growing, as opposed to Citi taking market share from others?
We have taken market share, I'm delighted to say. In fact, we're about a year ahead of the plan or 2 years ahead of the plan we put in place a year ago. It says I must have lowballed those numbers. But when we look at it, I think the piece I'm really excited about are the mid-market companies, because what we're seeing is they're either born digital players or they're ones who are participating in expanded global supply chains, and they're growing incredibly rapidly. So that's one of the areas of growth that we see the biggest opportunities. And you see it in the Middle East as they're looking at expanding and diversifying away from fossil fuels, adding more diversity into their economies. We're seeing it in the extraordinary entrepreneurs there are around the world, really taking advantage of the trends going on.
Recession, something everyone's talking about, speculating about, nobody knows. I believe you said in the past, at least, you think it's quite possible there'll be a recession in the United States second half 23. Also, you've talked about a recession in Europe. Is your view on that changing? Because some of the economic numbers are coming in a little bit more reassuring. Some people, even like Larry Summers, he still thinks it's more likely than that, but he's not as gung-ho on recession as he once was. Where are you?
So what we are seeing is different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but short of anything crazy happening geopolitically, and this time last year we wouldn't have predicted what happened in Ukraine, you've seen the tails come in. So you've seen the over-optimism from some about soft landings and the economy's doing well, but equally you've seen the severe case downside also coming in. I think the general view in the States, certainly one we hold at Citi, is we expect to see a mild recession, largely driven by the painfully persistent service inflation. It's coming off, but it's still pretty high, and we do expect to see central banks continue tightening as a result. But the vulnerabilities that amplified previous recessions around the world are not present. Banks are in very good shape, consumer balance sheets are in good shape, corporate balance sheets are in good shape. And I think that omens well for a mild recessions when they come, rather than ones that we have to be worried about.
Jane Fraser of Citi sitting down with Bloomberg's David Weston at the Year Ahead event. We're hosting over in Davos, Switzerland at the World Economic Forum. You can continue following that conversation at Live Go on a Bloomberg terminal if you are a terminal subscriber. TK, a couple of calls there. Tom Keene alongside me. I'm Jonathan Ferro, as you know. Tom, a couple of calls there on a recession, mild, off the back of the Andrew Hollenhorst work over at Citi.
The CEOs love to talk econobabble there, and of course she's got great ability, from Willem Bouter to Professor Mann, who now is with the Bank of England, on to Andrew Hollenhorst. And he's had a call. It'll be interesting to see how he mends that. But that's not what banking and finance is about. Jane Fraser, folks, is very different than Lawrence Fink, who did the fixed income route. She did the classic strategy route, Cambridge, HBS, the whole route, McKinsey, and now we go spend a cup of coffee at Goldman Sachs, and was brought in strategically at Citigroup to find a new strategy. And what I find fascinating about Citigroup, and Sonali Basak alluded to this on, I hope I remember it was Friday or Thursday, is a basic idea of what now for Citigroup. They have to catch up with a vengeance with the other banks.
Sonali's going to drop by later in the hour. In the next hour, Goldman Sachs, Morgan Stanley results coming up. Just to wrap up earnings on Wall Street, just to wrap up the price action right now on the S&P. We're down about 0.25% on the S&P 500. Talk through some of these stats. 4-day winning streak on the S&P, longest since September. Believe it or not, on a daily basis, quite remarkable. Weekly gain last week of 2.67%, the biggest weekly gain going back to early November. Futures just a little bit softer on the Nasdaq also. We're down 1/3 of 1% there as well. For once, the 2-year last week didn't do much. pretty much flat on the week, down a basis point or two, unchanged this morning as well. On a 2-year, 423.21. On a 10-year, 354.39. Yields a bit higher, the curve a bit steeper, up 4 basis points on 10s, on 30s, up about 5 basis points. And just to finish on foreign exchange, we've talked a lot about that dollar story, haven't we? Dollar index weaker since the end of September by more than 10%. Euro dollar at the moment, 108.20, unchanged. A little bit earlier on, it was Philip Lane speaking to the Financial Times. We need to raise rates more. We need to bring them into restrictive territory. That phrase, Tom, sufficiently restrictive.
Yeah.
They've got the depot rate to 2%. I think a lot of people out there at the moment across Europe thinking perhaps they get to 3.25.
Oh, again,
those ECB officials won't be talking about that number anytime soon, I don't think.
A mystery of it, and as we were talking to Elsa Lingos, I think Lagarde is the most under-discussed central bank right now. Christine Lagarde, obviously, at Davos, and I think she was in Brussels over the weekend here with huge challenges, including the small matter of a war. And how do you define their sufficiently restrictive versus the easy game of it in the United States?
So at the end of the year, she was blunt. Really, really blunt, very hawkish, the most hawkish news conference I've seen with President Lagarde perhaps ever in her tenure at the ECB. And that, Tom, was without the enthusiasm, the optimism that we could escape recession. Since then, Goldman's come out with a call and says we can escape the Eurozone recession. Deutsche Bank going into the weekend saying Germany can escape recession. You'd have to think that if we were hawkish in December with President Lagarde, that when we sit down in February, she's going to be even more so, isn't she?
Yes, I think that's fair. And from the good professor from Ireland, Mr. Lane, you see that. He's very astute. It's good to have Philip Lane assisting the non-economist Lagarde at ECB. We're an hour away. We welcome all of you on Global Wall Street, on radio, on television. Many different stories going on today, and one of them is the continued bank earnings of two non-banks, Morgan Stanley and Goldman Sachs. Devin Ryan is expert of this, owned the high ground for years at Sandler O'Neill, and with JMP Securities, a Citizens company, continues his wonderful work. Are Goldman Sachs and Morgan Stanley, are they banks?
Good morning, Tom. So they are banks, I think, increasingly embracing the benefit of stable funding, low-cost deposits on both the consumer side, Goldman now, increasingly transaction banking, et cetera. So I think they're benefiting from that, but, they're obviously huge capital markets players. Capital markets have been pretty challenged over the past year, and we're actually looking for a little bit better year in 2023.
In Davos in previous years, we've alluded to James Gorman of Morgan Stanley as maybe being executive of the decade in finance. That's open to opinion, and different names as well. It's all about wealth management. Is wealth management something that can be, can the Morgan Stanley wealth management success be replicated by other banks who want to be on the edge of James Gorman?
It's going to be really tough, Tom. Morgan Stanley, you made some tough decisions well over a decade ago coming out of the financial crisis to really change the model of the kind of legacy company. And they really ran full speed into wealth management. And with the Smith Barney acquisition, that really was transformational, where now there's such a level of scale. And that's just going to be tough for firms to kind of stick their toe in and try to do that. So we're pretty bullish on that.
You go right where I want to go, which is this idea of scale. Does Mr. Solomon have scale at Goldman Sachs? That seems to be under discussion right now.
Yeah, so clearly the big debate, Tom, is around what's happening in the consumer business. We've actually been a little bit more constructive. I think that Goldman should continue to think about how they evolve and what the bank should look like over the next 20 years. And sometimes the critics, want instant gratification over the next 1 or 2. But yeah, they're coming from essentially a very small base in consumer. They've had a wealth management business for a long time, and it's a really nice business. There's room for them to scale that. I think there's opportunities in areas like custody. And I think that it makes sense. They need to get much more disciplined around their consumer because they have to really watch their costs. And I think that's the big issue here.
Devin Ryan, help Global Wall Street right now. What do they need to look for in the vicinity of 730? What is the immediate item of importance for GS and MS?
Yeah, so I think 2 things. One, you can't have a big revenue shortfall, and that's obviously something that people will care about. But the bigger thing through bank earnings here is the outlook. What are people saying about the economy? Is it a mild recession or is it something worse? I think mild recession is the word you're hearing quite a bit over the last few days here. I think that's actually a good thing for businesses at Goldman and Morgan as well. So a little choppiness near term in our opinion, but we're more constructive on 2023 than I think most are, particularly the capital markets businesses off of a very abnormally tough 2022.
We're hearing so much more of that over the last couple of weeks. Devon Ryan of JMP Securities. Devon, thank you, sir. Morgan Stanley and Goldman just a little softer in the pre-market, down about 0.4% on Morgan Stanley, down 0.8% on Goldman. Those numbers due in the next 50 minutes or so, TK, to wrap up earnings on Wall Street.
Different companies, and we can wax all we want on the drama of it and the soap opera of it. The overarching theme is everybody wants to do what James Gorman has accomplished. They want to do wealth management because of the persistent fees, the index nature of it, the capturing of BlackRock-like assets, and on and on. And I just, forget about what we're going to see with Ken Leon here in a bit. Going out 2 years, 3 years, 5 years, John, how do they achieve Gorman-like success in wealth management? I haven't figured it out.
Have you got to pay up for it? You've got to go out on the buying spree like Gorman did. And where do you find them right now?
And Solomon's doing that in consumer banking, and it's not working out. I don't have the numbers in front of me, but the per-account acquisition costs of doing Marcus is difficult.
Well, they're trying to do it organically, aren't they?
Yes,
precisely. That's the big difference.
That's very good. That's very good. Very MBA of you.
Is that right?
Is
that what they do it? McKinsey.
Organically, yeah.
And HBS.
Avocados, bananas, they do it.
What have avocados got to do with anything?
You have breakfast and then you talk about organic strategy.
Okay, nice.
You like that?
And a coffee and then you move on.
Yeah.
Do they play golf anymore? Is golf a thing?
No, they don't do golf at Davos. We tried that one night at 3 a.m. Barry teed up the ball.
How did that work?
It was good. Rachel had the 4-iron out and, shanked it. She hit the guy from Coldplay. In the head with a golf ball.
The lead singer?
Yeah. He was downfield. And
do you remember the night I almost broke my hip?
Yeah.
Good times. Okay.
I remember being horizontal in a Mercedes. I could barely fit in.
Oh, because you had to lie across the back.
And I can't remember his name. It was Peter. I don't remember his last name. Peter was in the front seat holding my legs up just to be sure I could get home.
I'm sure that was quite a night, Tom.
It was. Well, the sun was coming up.
7:30 Eastern Time. We're going to catch up with Ken Leon, the Director of Equity Research at CFRA. It's about 6:41 Eastern Time right now, so only about 49 minutes away to catch up with Ken. Off the back of numbers from Goldman and Morgan Stanley, Shani Bassett's going to drop by the studio in just a moment to break down them when those numbers come through. Equity futures right now on the S&P. We're down about 1/3% on the S&P 500. No real drama here. Yields a little bit higher at the long end. Curve a bit steeper. 10-year 355.13. Yields higher by 5 basis points. And crude with an 80 handle on WTI. $80 and about 20 cents. Crude up 0.5% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. In the Ukrainian city of Dnipro, rescue crews are still searching for 25 people missing after a Russian missile hit a 9-story apartment building. At least 41 people were killed and dozens more wounded. Now, for the first time in 6 decades, China's population is shrinking. It's the latest milestone in a worsening demographic crisis for the world's second largest economy. Government data says that at the end of last year, China had over 1.4 billion people. That's 850,000 fewer than the year before. The number of births was the lowest since at least 1950. A new report says that international trade will grow more slowly than the global economy after most of the next decade. According to the Boston Consultancy Group, the war in Ukraine will reshape strategic alliances and alter the flow of cross-border commerce. The report forecasts that trade will grow at an average of 2.3% through 2031. In Venezuela, public sector workers mounted the biggest anti-government protests in years. Workers organized at least 50 protests yesterday in Caracas. Teachers were joined by nurses, pensioners, and others demanding more money from the government. They have been falling behind in an economy that embraced the US dollar. And Microsoft says it will add the virtual artificial intelligence bot ChatGPT to its Azure cloud service service soon. The company already has a relationship with the bot's owner, OpenAI, and may take a larger stake. Bloomberg has learned that Microsoft may invest as much as $10 billion in OpenAI. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
I do think that the opening up of China, the impulse it gives to consumption in China, energy need, commodity need in China as well, I do think it's a very good signal. It will be supportive of a momentum, but the true inflection point we have not kind of seen yet. We have certainly advised them to go long on China and to be overweight on China.
They're not the only ones. That was Ralph Hammers, the UBS CEO, sitting down with Bloomberg's Manus Cranny in Davos, Switzerland, a little bit earlier on. China GDP coming in better than estimated for 2022, but the economy growing at the second slowest pace since the 1970s. Big banks betting on a stronger recovery in the coming months. Standard Chartered, one of them, Morgan Stanley, another. Bank of America expecting growth of 5.5% or higher. Tom, by year end. Punchy calls that just weren't there several months ago.
I like that. Punchy calls is the right way to put it. And all of a sudden, we're beginning to model out 5. And who was it? Somebody had a 6%. Ed Hyman?
Evercore.
Yeah, Evercore.
It was Evercore.
ISI.
Julian Emmanuel sat in that chair and said 6 handle on China GDP.
Yeah, well, there's the recalibration here back to something that we remember. Enda Curran is acutely aware, as our chief Asia economics correspondent, it is not the past. And over the weekend, the bombshell that it is a China with changed demographics. And let me cut to the social chase. There was codified out of the time of Mao of one child. And a number of years ago, I'll guess 10, there was some form of amendment to that. Does China need to be a 4, a 5, a 6-child family nation?
Well, certainly they are now seeing the end result of that one-child policy, Tom. Like you mentioned, we had these population figures out making the point that China's population has shrunk for the first time since 1961, when China had a great famine, of course. It is the legacy of that one-child policy that did change over the past decade or so, 2-child and a 3-child policy. And of course, now the authorities are trying to encourage people to grow their families, to have more children. They're offering subsidies and the like. And obviously it's going to become a pressing concern for them because the working age population is shrinking. There are more deaths than births.
Yeah.
Of course, we're also in the middle of this public health crisis. We don't quite know what level of fatalities China is experiencing. So it's a much more important structural negative for the economy than the day-to-day headlines around the COVID-0 impact.
What's so important here, and for those of you on radio, the slope, the degree of change of births in China is pre-COVID, and it is stunning. That is the correct mathematical word. I hope that John Ferro will let me use the word stunning. And Curran, what do they do as a social policy to increase births? Is it a new safety net that Xi has to come up with?
Well, they're talking about subsidies. The authorities are looking for ways to coax families to have more children. But of course, people are more reticent now. The cost of raising a family is more expensive. Typical living pressures like work, commuting to and from work and everything else that you experience, not just in China, of course, but around the world. Marrying later, all these social trends are weighing against expanding families in China. And that's now really coming home to roost, and I think is going to be a major headwind for economic policymakers in the years ahead.
John, look to the Northeast, Japan, Korea. That's what they're worried about.
I want to finish on population growth just briefly. Ender, I wonder what's more important here, the overall population growth or the urban population growth? Ender, is the latter a little bit more important? Is that what you focus on?
Well, it's the labour force that you really focus on, John. It's, as you say, it's not really the absolute size of the population. It's what's happening with your labour force. How productive is your labour force? How skilled and how educated are they? I mean, there's an argument saying that it's not necessarily about where the headline rate of employment is going for China. It's what are they doing with those who can work? And of course, the workforce in China is shrinking, and that's what's really alarming people. And the concern is that they are on a similar path, like Tom just mentioned, to other neighbours in Northeast Asia.
Chinese Vice Premier Liu He speaking in Davos, Switzerland at the moment. Tom, here's a headline for you. Life has been restored to normal in China. Life has been restored to normal in China. That headline just crossing moments ago.
And is it normal?
I can't speak for all of China, Tom, but it certainly is a lot better in Hong Kong. Airport is reopened, the crossing in the Shenzhen is reopened, but there's still a fairly subdued feeling here. I think we need to get over Chinese New Year and then see what the mood is like then.
John, I just think, you, me and Lisa in Hong Kong.
You want to go?
I just think it's a celebration
I don't know if
of
I'll
our
get,
team in Hong Kong.
I don't know if I'll get
so hard.
the invite, considering the question I'm about to ask. He also reiterated China opposes unilateralism and protectionism. Enda, can you make sense of that for me? How could a Chinese official seriously come out and say that they oppose protectionism?
Well, quite right, John. But this, of course, we all know what the backdrop here is. Chinese officials have typically used Davos as a platform to sell itself to the rest of the global economy, that they're open for business, that they operate by the rules of the international liberal rules-based order and everything else. And this is a line they've trotted out before. But of course, it's specifically being aimed at the US. They are pushing back against those tariffs. Remember now, he's going to be meeting the US Treasury Secretary over coming days. You can be sure part of that conversation will be tariffs on Chinese goods. So I would imagine he's just setting a bit of mood music ahead of those talks.
He knows his audience. And a thank you. And a Karen.
That's
over in Hong Kong.
Enda's got the best
Thank
definition.
You, sir.
Davos, it's mood music.
It's mood music. It often is, right?
Music.
Isn't it always just mood music?
Yeah, my answer is when you're traveling is usually they play Fleetwood Mac. The only difference is
that
it
your
rumors
favorite?
No, it's not my favorite. That's what they play. It's just that's the mood music.
Opening up is a key driver of economic progress. China will always promote all-round opening up. That's the kind of thing the West wants to hear in Davos, Switzerland.
It's like what Mr. Fink was talking about.
TK, what happens exactly? What happens off the back of it?
Well, everybody goes home and tries to make the next marginal profit dollar down the income statement. That's what they.
Are we really going to take headlines like that at face value? That
no,
China,
we're not. That's our hallmark, John. No,
Chinese...
this is what we've done for 20 years. John hits the third rail here. This is what we've done for 20 years. Is we don't take it at face value. We respect that they go. I respect that they go there. I love beating up on David Rubenstein just as an example, but he dishes it right back. These guys. That interview we did with Moynihan there. A year or 2, 3 years ago, that was on
several
fire.
Years ago, yeah.
We talked to a banker about banking. That's what That's what they don't. They want to talk about hope and.
Do you remember? I remember when President Xi, the leader of the Communist Party,
place stopped,
and China, spoke to the audience at Davos. He was that lead speaker, and then all these articles came out that China was kind of the new flag bearer of the global liberal order. I mean, what on earth was that nonsense about? I mean, I've been there. I've been on both sides of the wall. Been inside the World Economic Forum, outside of the World Economic Forum, and just sometimes people seem to get carried away with what happens there. Don't you think?
Yeah, I've seen you outside the wall there. Those 2 hockey players, really good hockey players. They got their place down there. They go from DLD in Munich and they come up to Davos. There's a whole Davos, folks, outside of the World Economic Forum. Shh, don't let them know. There's a whole second Davos going on right now.
What's the second Davos? What
does that mean?
Different
tinge. It's a lot of people on business and building relationships and all that, and there's a lot of hangers-on, just like you'd think at like a rock concert or something like that. That's sort of maybe very crypto-y and that. And then there's a lot of other people just there to be there, looking to make 1 or 2 relationship contacts. I mean, I get stopped in the street constantly by people. I have no idea who they are. Usually trying to sell me BitDog or something,
And you never bought?
No, I don't. I have my crampons on. I got the little, sticky mountain
the spikes.
Things, the spike.
That you put your boots in.
Yeah, I wear them for like 5 days straight.
I've never seen them.
Mm-hmm.
Okay. All right.
They're on a set
Should
too.
we leave that conversation now? I feel like that's died.
Yeah.
Equities right now on the S&P down 0.2 of 1%. Coming up, Chris Harvey, the head of equity strategy at Wells Fargo Securities, going to join us in just a moment.
Important conversation.
Look, on the road ahead, we've got Mike Wilson and Morgan Stanley out early this morning.
Yeah.
Basically saying, and I love this line from Mike Wilson earlier this morning from the team at Morgan Stanley, bear markets are like a hall of mirrors designed to confuse investors and take their money. Isn't that a great line?
Yeah, it is. John, we're about ready to round it up. $86 Brent crude. Is that the backstory 4 days from now in Davos?
Goldman. You saw what Goldman said in Jeff Curry, didn't you? They see a bullish concoction. A bullish concoction.
That's Chicago talk.
Commodities. Is that what that
That's
is?
what Krasner would say.
We're going to try and catch up with Jeff later this week, hopefully.
Yeah, we hope so.
Try
We're
and make
working on
that
it
happen.
right now. A lot of good oil voices to talk to, including our Javier Blas.
Cool, very cool. Okay, so coming up shortly, Chris Harvey of Wells Fargo to break down the equity market. In the next hour, you'll get results from Morgan Stanley and from Goldman Sachs as well. Shanali Bassett's going to drop by the studio and bring you the latest numbers on all of that. We'll tie that all together and push forward to the tech results as well. Just to get you started, and welcome back from a long weekend if you're joining us stateside. In the equity market at the moment on the S&P 500, shaping up as follows on the S&P. No real drama here, down about 0.2%. Equities lower, soft and negative by 8 or 9 points on the S&P 500. Yields a bit higher here by 5 basis points, 355.50 on a 10-year. Euro dollar not giving me much, 108.26. Those of you interested in the data, retail sales a little bit later this week. Interested in the Fed
Glad
speak?
you mentioned it.
You'll hear from Mr. Williams of the New York Fed. Some welcoming remarks a little bit later on this morning, I'm told. That's scheduled for about 3 p.m. Eastern time. The New York Fed's John Williams, Tom, giving some welcoming remarks a little bit later. We'll see if he talks about monetary policy or not. Live from New York City this Tuesday morning. Good morning to you all. This is Bloomberg.
Let's pull the camera back and think long term.
If we do go into a recession, it will be a mild one.
Consumers still seem to be spending. The labor market still seems to be strong.
We could have goods deflation this year. That is a very different story to last year when US inflation was accelerating.
We're getting more confidence, especially for the large banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Later this hour, wrapping up earnings on Wall Street with Goldman and Morgan Stanley, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance with Tom Keene. I'm Jonathan Ferro. Equities negative, just a little bit, TK, down 0.2%. Earnings a little bit later this hour.
Got a Monday feel, but it's Tuesday. It's going to be an interesting 4-day weekend. I love what you mentioned at the end of the last hour, John, is the hallmark this week. It's not going to be CPI Thursday or this, that, and the other thing, but it's going to be about 70% of the American economy to get that we're all going to die and have a recession call readjusted, recalibrated.
You don't hear much of that anymore off the back
Retail
of the rally we've
sales.
seen. Hey, the rally in EM, the rally in European
Yeah.
equities. I mentioned it a little bit earlier this morning. I'm going to go on and on about this. We've had 9 trading days. The Euro Stoxx 50 is up almost 10% year to date.
Yeah, I'm going to round it. As
What
I
a
mentioned, the equity market, absolutely, with 21, 22 VIX coming into an 18 level. Right now with some Monday angst, 20.04, right on the cusp of a 19 handle. But, you know, as Chris Harvey mentioned, it's been growthy versus the value certitude that's out there.
I should specify we've had 9 trading days stateside, of course, and high yield spreads, Tom, are much, much tighter as well, by more than 60 basis points year to date. So it's not just EM, it's not just European equities. It's high yield credit, junk bonds in America too, where there's a really sizable bid. Dollar's weaker, commodities are rallying. I think copper's rallied by almost 9% year to date as well.
Yeah.
Just getting bulled up on a cyclical story off the back of China
Absolutely.
reopening.
And last night, Bramo was at the Belvedere Bar having some of that famed barley soup, $30 for a small cup of it. You'd love it, John. And the answer is Bramo brought the bar to a complete silent moment, talking high yield spreads coming in.
Pain trade.
Pain trade.
Pain trade.
Pain trade.
Risk
right
assets
now.
go up from here.
Yeah.
Bank of America with a fund manager survey a little bit earlier this morning saying exactly that. The pain trade is that this continues. I mentioned Mike Wilson and Morgan Stanley. Here's the note from Mike this morning. Here's the full note, the full quote, the lead paragraph. And I'll get to Chris Harvey of Wells Fargo on his view on this. Bear markets are like a hall of mirrors designed to confuse investors and take their money. He went on to say, trust your fundamental process for us. Margins and earnings are likely to significantly disappoint whether there is a recession or not.
And what's important here is the timeline. Mike Wilson's idea of long-term within, you know, the structure of a big Wall Street firm is, I'm going to say 6 months, 9 months, maybe a year. What do you do, John, if you have a longer-term time frame, 3 years, 5 years, coming out of a pandemic, China reopening, you've had this nice gift of a lift, then what? And that's sort of where we are going into February.
Let's do some of that right now with Chris Harvey, the head of equity strategy at Wells Fargo Securities. Chris, let's start there. Bear markets are like a hall of mirrors designed to confuse investors and take their money. Is this a bear market rally?
Bear market rally. This is a rally, no doubt. Has a lot of the hallmarkings of a January effect, as you were pointed out. Credit spreads are tightening, high yield, IG, but risk is rallying, smaller caps are rallying. I don't know if I'd call it a bear market rally. What I think is we're probably going to begin to stall out here We think fair value in the short term is somewhere around 4,000. And at the end of the day, it's true that not credit spreads, but margins are going to compress. EPS is going to come down. But we think we're really facing more of an economic malaise than we are some sort of sharp recession. And so as a result, you have to be careful. You have to place your bets. We think mid-cap growth is that sweet spot. And overall, the broader market's a little bit tough. We think things will trade higher, but you can see a pretty big downside from here.
So, Chris, within that, there was a call on the economy and there was a call on earnings. Can we just separate the two just for a moment and focus on earnings, Chris? What kind of earnings are you expecting this quarter and the outlook for the rest of the year?
Yeah, so let me say this. For the last 2 or 3 quarters, there's been a lot of fear-mongering coming into earnings, right? And so when you fear-monger, what happens is you lower expectations. We've lowered expectations so much in the last couple of quarters that the numbers haven't been great, but the phrase, things are better than expected, has been true. And I think that's going to be true this time around. We are going to see some margin compression. We are going to see some revisions down, but now's not the time where you really lower guidance because the economy's still okay. What we're worried about more so is when you report first quarter numbers, but right now we think things will be okay for now, or better than feared is probably the right word.
Christian, in your beautifully concise note, you speak of a tactical shift. And I get that there's been a tactical shift. Everybody's gotten this mother of all recession calls wrong. Help me with April, or May is June. How do I prosecute tactics now to survive into second quarter?
Tom, that's a great question. And that's a question that we're having with a lot of clients. We had a lot of clients that performed quite well last year come into this year, and they've just gotten run over. And what they're saying is, hey, do I turn? Do I shift? Do I tactically move? And our answer is no, right? Because ultimately, we're going to see some sort of downside. We're going to see some sort of pain, whether it's economic, whether it's earnings, or whether it's macro. And so we have 12 months in the year, too early to shift, and there's a lot of room between now and then. So at the end of the day, we're having a bounce.
Right.
That bounce we kind of understand, but ultimately the worst isn't over just yet.
Chris, the financial media is guilty of this, and frankly, Bloomberg and myself, we're as guilty as anyone of a complete focus on the big banks, in what Wells Fargo's doing and the rest. Okay, great. After the big banks, which earnings matter to you?
So what we're looking for is we're looking at cyclical earnings, because we think that's where the pain is going to be, right? Cyclical earnings, the old economy stocks outpunched their weight last year, and that's where we think the pain is going to be. If you're going to believe that the economy is slowing down, which we do, that's where you should see most of the pain. That's where we should see the margin compression, and that's where I think stocks are most liable.
Chris, are banks part of that cyclical story that you just described?
Yeah, banks are part of that, but we're not as worried about credit as other people, because one of the reasons being is the job picture is much better than many people expect. And we expect the job picture to be pretty robust, at least for now. And so as a result, credit should be okay. And what we've seen so far is credit's not great, but it's normalizing. It's okay, or it's where it should be. It's not worse than expectations.
For a long time, we used to talk about tech as the secular growers, these big things that didn't worry about the cycles of the global economy. Chris, do you think those tech names are now cyclicals?
So, some of them, if you look at semis are definitely cyclical. Software, I'd say less so. And one of the things that we're seeing is a lot of industrials are becoming a little bit more growthy. And here's the thing. The big debate that we're having right now is what takes leadership? Is it energy? Does tech come back? And what we think is it's going to be a lot more idiosyncratic market. Don't look so much for this one big trade or this one big knockout. Really get back to the fundamentals. Look for that good risk reward. Again, we think it's in that mid-cap growth space, and you can get some good valuations down there, 15 times earnings or so. And don't focus so much on the macro.
Okay, well, that's great. I'm focusing right now on S&P 500 up 4.2% in, 9, 8, 10 days, whatever we've had this year. Are you going to give me a double-digit return in 2023?
So what we think in 2023 is ultimately you're going to get to 4,200. You're going to get to 4,200 because we think rates are going to come down. We think inflation is coming down, and we think the economy is slowing. And what is that? That's a growth market. And what is the S&P 500? That's a growth indice. And at the end of the year, even if the Fed doesn't cut, which we don't think it will cut, the market will believe that it's going to cut, and we should see that reflected in the shape of the yield curve and interest rates.
John, go to Chris on this. This is the heart of Bloomberg surveillance. Do we have two opposing views here between what we see from Wells Fargo and what we see from Morgan Stanley? Couldn't be farther apart.
Are you talking about the path or point to point?
Both.
Because the shape of the path, I mean, Chris, didn't you talk about a potential for real downside here in the near term at least?
That's right. We think there's downside to 3,400, but ultimately you do recover. Right, we do think that we end up higher. 4,200 is the high for this year, and we do think we get there. We think that, again, what you're facing is more of an economic malaise, not a sharp sell-off, not something that's going to be horrific. And as a result, we can muddle through that. And let's not forget, the Fed is going to, or we think the Fed's going to stop raising rates sometime this year. That's a positive. And if we get through a situation where it's more of an economic malaise than a sharp sell-off, then earnings, they'll be dented, but they won't collapse.
Hey, Chris, enjoyed this. Thank you, buddy. As always, Chris Harvey there of Wells Fargo. So point to point from here to year end, looking for 4,200, looking for downside to 3,400. Tom, I can tell you, Greg Bowdle over at BNP Paribas, he thinks we end the year there, 3,400 on the S&P. That's your range of calls out there at the moment. The average, if you want the average, Tom, for year end, is just north of 4,000.
I really thought about this a couple hours ago. I mean, being a strategist right now is brutal.
Sucks.
You've got a supply side. That's a nice way of putting it. You've got a supply side. Seriously, you got a supply side shock in an historic moment, a once in a lifetime pandemic, and you're supposed to game economics and central bank dynamics with a fixed income market always placed before equities, bring it over down the income statement to the revenue line, and hopefully the distinction of profitable and non-profitable companies. It is really difficult.
It's really difficult. I keep going back to this, Tom, and it depends what seat you sit in. We can have a conversation about what is good versus what is bad, and we can have a market conversation about what is getting better versus what is getting worse. And I think capturing that this morning was the fund manager survey that came from Bank of America. First line for you, Tom, in this quote. A net 50% of fund manager survey investors expect a weaker economy in the next 12 months. That's not good. That's bad. But is it better? It's better. This is actually the most optimistic FOMS investors have been on global growth prospects in the past year. That's captured by the fall we've seen in cash positions. It's captured by the increase we've seen of people who want to be in EM, in cyclicals in Europe.
And I'm going to call a value bet at the end of last year as a general statement. And so far, we've had a certain level of growthiness. I'm fascinated by what the big techs do. I mean, they're all laying off and doom and gloom and all this. And I have no idea what big tech's going to give us here in a couple of weeks.
And neither do I. Apple in early February, that's going to be the first stop. I've had a lot of people message me about this, Tom, and I think this is important. We're talking about all these banks saying buy risk, buy EM, buy Europe, buy cyclicals. And then the people leading those banks are making decisions to cut people off, increase reserve for losses potentially later this year. The leadership's become very defensive.
What you don't
the South side's becoming more
is not
constructive.
mentioned at the meetings of the World Economic Forum is in 17 minutes, they're going to sell to the street how profitable and responsible they are while they cut the bonuses of the people not going to Davos.
Precisely. About 20 minutes away from here and from Goldman Sachs.
I couldn't get the Gulfstream
and Morgan Stanley.
I couldn't land it.
Equity futures on the S&P down 0.2. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. In China, the economy proved more resilient than analysts forecast. Last year's GDP growth of 3% was the second slowest since the 70s. Still, data from the fourth quarter and December came in better than what economists had expected despite a COVID outbreak. That suggests the worst of the slump may be over. Meanwhile, trade between China and the US is on track to break records. US government data through November suggests that imports and exports in 2022 will add up to an all-time high. The final report is out next month. Here in the UK, teachers are joining other workers who have gone on strike and they fight for higher pay. The teachers' union says members in both England and Wales voted overwhelmingly in favour of industrial action. Meanwhile, nurses do plan to stage another walkout next month. The chief economist of the European Central Bank says interest rates will have have to move into restrictive territory to tame inflation. Philip Lane told the Financial Times we need to raise rates more, but he also said that policymakers need to be flexible in both directions. And it's a rare case of an activist targeting a prominent Chinese company. Meme stock investor Ryan Cohen has taken a stake in Alibaba and wants the e-commerce giant to buy back more of its shares. That could put Cohen at odds with China's President Xi Jinping, whose administration has wiped out growth at Alibaba and other big tech companies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The number of billionaires went up during the recession. Up. They didn't go down, they went up. Raising taxes on working families, making inflation worse. Let me be clear. If any of these bills happen to reach my desk, I will veto them.
The President of the United States.
It's whispering.
I know. It always gets me. The President on policy on the other side of the aisle. AMH is going to join in just a minute.
John, someday I'm going to be as old as President
Are you going to whisper that?
You're going to be
will you
here.
Shonali's
going to hold my walker, and I'm going to be here. Watch the end.
Are you going to whisper for emphasis? MH, your mic is hot. We'll get you in a second. Equity futures negative 0.2 on the S&P 500. TK a little bit later this hour. We'll catch up with Shonali in a few minutes' time. Goldman, Morgan Stanley, just around the corner.
Just around the corner, 7:17. Let's get very quickly here to Anne-Marie Horton in Washington. What is on the president's agenda today, Ms. Horton?
Well, it's definitely not watching the yen. Sorry about that. The president today is going to be sitting down with the Prime Minister of Netherlands, Mark Rutte. And this is, of course, they're going to talk about Ukraine. Netherlands has sent about $3 billion. Potentially there's going to be another billion on tap. It comes on the heels of his phone conversation the past 24 hours with President Zelensky. But also, we spoke about the last hour, also on the agenda is the fact that the U.S. wants to make sure Netherlands is on board with curbing some of this advanced technology for semiconductors to China. This is a big deal in Netherlands because one of the crown jewels of their economy is ASML. So this is an important meeting the president's going to have, and it comes on the heels of his meeting with the Japanese prime minister, who they are also trying to coalesce around this.
Very quickly, Anne-Marie, as we wait for Goldman Sachs to come out, the horror that I observed this weekend in Ukraine was it the worst ever? I can't go there. I'm not an expert. How does the president adapt and adjust to what we saw this weekend with a missile that can take out an aircraft carrier?
Yeah, and also, of course, that civilian infrastructure building, which the death toll we saw rise again this morning, it included a number of children. Incredibly devastating images, absolutely horrific, to be frank, coming out of Ukraine. I mean, the president, the United States has recently sent a number of advanced equipment, including the Patriot missile battery. The news really over the last 72, 48 hours was that the UK is going to be sending these tanks. And there's a lot of pressure now stepped up on Germany to send also Leopard tanks. So I think those images are going to dictate and maybe push some that are still waiting on what they potentially may or may not send into the direction of potentially sending those weapons.
What a time for a conversation with Chancellor Scholz. A little bit later today, sitting down with our Editor-in-Chief, John Micklethwait. AMH, Anne-Marie, over in Washington, D.C. Anne-Marie, thank you. This from City's Andrew Hollenhorst, Tom, just moments ago. I think Jane Fraser referring to some of his work in her interview a little bit earlier on this morning with David Weston, Tom. Our base case remains 50 basis points for the February meeting, despite the modest probability being priced. We think policy rates end the year comfortably above 5%, in contrast to this market.
We got data out to February 1. I'm going to say what I've said before. People make fun of me about it. We're massively, massively data dependent for retail sales, the dynamics there of the control sale, and just at all, we're data dependent. That's all there is to it, between 50 and 25 basis points. Right now, we're very data dependent.
Waiting for some data out of Goldman Sachs, and it drops right now. The fourth quarter EPS coming in at 32. I'll get you a comparison to the estimate in just a moment. Net revenue 10.59 billion, the estimate 10.7 billion. Provision for credit losses $972 million. Loans $179 billion, the estimate $178.67 billion. We're looking for some of the trading numbers, as always, with Goldman Sachs. And Shonali Basak alongside me, looking for the same thing. Hey, Shonali.
Listen, they just came in blowing through estimates. When you look at that trading data, it's interesting. This year is the year to ask whether this is sustainable, whether you can keep on inking $3.5 billion a quarter in the fixed income unit. Remember, that is a much bigger number than we're seeing over at peers. You also see Goldman Sachs coming in above line when you look at the equities trading revenue. When we look at Morgan Stanley, we're going to be watching for another quarter if Goldman is coming in ahead of them on that regard. You're looking at net revenue, however, overall coming in a tad shy of estimates, John. So when the rubber hits the road for Goldman Sachs, are they going to be judged on the core businesses that they come on beating on very strongly here, or are they going to be judged here on some of these moonshots that they are looking to now reorganize quite a bit?
Well, let's talk about the different parts of the bank, Tom, just briefly. Fourth quarter IB revenue comes in at 1.87 billion. The estimate 1.64 billion. Unsurprising, Tom, given the year we had in markets last year, bonds down, equities down, to see this line, significantly lower revenues in asset and wealth management.
Well, they're going to partition out, and that's what they do, folks, in a PowerPoint. I mean, I'm looking at 14 pages of data in detail here. Shonali, do people look at this as a normal analysis day, or is it completely focused on Mr. Solomon's consumer experiment?
There's a lot of questions about the consumer experiment and where they make money from above and beyond that. So the asset and wealth numbers increasingly important as we truck along here. Now, to the point that you're making, this is a tough business for everybody. But at the very, very end of the day, no matter if you're playing in asset or playing in consumer, let's talk really quickly here about the ROE number. The number that we're looking at here of 10.2% is well above estimates. The expectation was 7%, but you are watching Goldman Sachs come down to earth quite a bit. Remember, last year they inked a number there at 23%. So what is normal for the Solomon era? The medium-term target is 13%.
Can you compare and contrast the numbers we're seeing with the decisions that they're making in the C-suite at the moment? Compare and contrast this report to some of these severe cuts we're expecting to the workforce.
You know, it's funny. I was looking back 5 years this morning just to kind of reminisce about efficiency ratios over at Goldman Sachs. And the reason that's important here is because Goldman Sachs is more efficient than Morgan Stanley. Their numbers are better on efficiency. However, because the ROE is not coming in as hot, you have questions about how you bring that overall profitability up at Goldman Sachs. The reason I bring this up is because those 5 years ago, you did not see that efficiency number posted at the top of the release. And now you certainly do. So those cost cuts are very important over there at Goldman Sachs.
I want to bring up a banner here. We're running the red banners. For those of you on radio, we're running the red banners here. Brad, this is so important. We got to put this banner up. And I heard this from Goldman Sachs bulls over the weekend. Shonali, right, and I give them great credit for doing this. Net revenues for 2022, Platform Solutions, I still don't know what that is. Platform Solutions is 3.17% of net revenues. We're talking about Marcus and the rest of it like it's 30% of the bank. It's a rounding error. Why are we so upset if it's 3.17% of revenues?
That is the favorite question.
Did I do okay? I'm sorry. A guy said to me, it's minuscule.
There was a presentation earlier last year that showed you that $100 billion in deposits they had brought in through that business also changed their funding mix quite meaningfully. So to the point, it's a small business. It loses a lot of money. We had a banner below showing the provisions for loan losses at that business. That is part of the costs in addition to the overall cost you're seeing at that business. So yes, that's why I was saying, Tom, that this asset and wealth management business becomes all the more important. And if you look at it, even though you see pressure on the fees, you do see the business come in above expectations on revenue at asset and wealth.
Are they going to be organic in wealth management, or are they going to do an Eaton Vance? Eaton Vance, folks, is a wonderful Boston shop that Mr. Gorman picked up. Can they find an Eaton Vance, or are they going to grow it?
You know, it's interesting. There's this young chap there called Julian Salisbury, and the focus there for him is not just what you're seeing over at Morgan Stanley, passive, starting to float into all these banks, but there's a line here that talks about their private investments, equity, debt, the decrease in equity values and the decrease in debt investments. This all comes as you're watching Goldman Sachs look a little like KKR. They're focusing on private markets over at that asset manager. It's a competitive business. It's a higher fee business. And that's why it matters.
There's some people who want to be paid a little bit like maybe some people at KKR as well. Shanali. Let's start Goldman's down about 1% in the pre-market. Your broader equity market still down about 1/10% or 2 on the S&P 500. That's Goldman. One still to go. Morgan Stanley. Shanali's not going to go anywhere. We'll break down those numbers when they come through, and we'll catch up with Ken Leon, the Equity Research Director at CFRA. All of that still to come. Equities down, as I say, but trying to recover by about 1/10% on the S&P. Alongside Tom Keene, I'm Jonathan Ferro. This is Bloomberg Surveillance. Goldman numbers out just moments ago. No real drama here. We're down about 1.7% in the pre-market. I'll keep an eye on that for you. Morgan Stanley earnings still to come. Shanali Basak alongside Tom Keene and myself will break down those numbers for you when they come through. Equities shaping up as follows on the S&P 500. We are negative by a little more than 1/10% on the S&P after a 4-day winning streak on the S&P 500. On the Nasdaq, down about 0.2% in the bond market. For once last week on a 2-year, a little bit of a snooze. Your 2-year right now, 423.21. Getting some numbers from Morgan Stanley at the moment. Fourth quarter net interest income, $2.32 billion. The estimate, $2.5 billion. The all-important wealth management net revenue number, $6.63 billion. The estimate, $6.14 billion. Going through some of these numbers for you. As I say, Shanali Basak alongside us. Shanali, what do you see?
I think one thing important here is the fixed sales and trading revenue missing expectations. When you had Goldman just come out with not only a beat, but the biggest jump on Wall Street at 44%. So what are they going to do over there to get competitive in fixed income? The other question I have is about equities sales and trading revenue. You have it come in below expectations at $2.2 billion just about. Remember, that is the king on Wall Street typically coming in higher than Goldman Sachs by absolute numbers. So they still inked out a gain there. But again, why the miss is the big question here. So, kind of mixed results here if you look overall. The trading desk, obviously, the reason it's important is a twofold question. One, performance in a tough market for equities, but also because, remember, we had Jonathan Pruzan over there on his way towards stepping down this month over at Morgan Stanley. Puts a lot of pressure and a lot of spotlight on the other two major deputies here, Ted Pick over at the trading desk, as well as Andy Saperstein over at the wealth management business, as we've been talking about getting more and more competitive by the day.
I look at the return on ROTCE, return on capital, and some of the other measurements here, and the answer is they're just simply more profitable than Goldman Sachs. Is that the short answer?
They aim to be, is the question here. In a few minutes here, we'll also look at the post that they put out for their strategic objectives. They tend to do that at the end of the year to see if anything has changed. But if you look at their medium-term goals, they are in line at the high end of the range. They're higher than what Goldman Sachs has targeted to give you. But today, at least, they're not, Tom. They're slightly below in return on equity where you see Goldman Sachs.
And to their credit, John, like all the banks, are really getting much better clarity on these releases of tons of data. John, a single sentence. The wealth management business delivered 6% full-year annualized growth rate from the beginning of the year. Now, I believe the stock market was down 20%. I believe the bond market was down 14%.
Battered.
I think I'm impressed. I don't know how that's adjusted for Eaton Vance or E-Trade, but maybe I'm impressed by that plus 6% statistic.
Morgan Stanley, the stock is down by just 0.4% of the pre-market. Mentioned Goldman down by 1.9%. Goldman reporting about 15 minutes ago. Can we go there, Shanali? Just take stock of everything we've heard over the last week, from Friday into Tuesday. All the big names have reported now. How defensive are they set up going into the rest of 23?
All of these banks are playing offense here. Remember, we're not going to see full numbers right away in terms of the breakdown, in terms of risk being taken on by each of these banks. But you saw value at risk rise over at JP Morgan. And you're seeing that with pressure on the trading desks here. So to the extent that institutional businesses can give you some money into a tough market, questions. I think also interestingly here, if you look at our numbers for Morgan Stanley, net interest income is slightly below expectations. They have a wealthier client base by mix here. So how much net interest income can you see them boosting from their asset and wealth management this year?
Shanali, thank you. Great work. Do you take the rest of the year off now? See you in a second quarter, something like that? TK, after breaking down all the banks in the last couple of days. You always complain about the banks. I do too. I hate the way they report all at once. All at once in the morning.
Yeah, I think
wish they
it's
just,
manipulated.
take it easy.
Yeah.
Do what tech does. Do it after the close.
I agree.
You know?
I do agree, but I will say that their clarity of presentation, I was a huge critic 5, 6, 7, 8 years ago.
You've upgraded them.
No, I think they've really listened. They're like in English. I mean, anybody can look at this, whatever their sophistication, and get a feeling for the distinctions between the two.
When you say they've listened to you.
No, they don't care. They listen to Shanali.
Oh, they listen to Shanali.
Yeah,
and the feedback.
you know.
Okay.
All I can say when times
Shanali's
are
a
good,
power out in LinkedIn. I mean, she publishes for LinkedIn.
Weekly.
And Global Wall Street
Weekly.
stops.
Are you on the distribution?
I am. I never
too.
read it, but I'm on the
I
distribution
get it in my
list.
inbox.
you read it. I see who picks up.
Do you want to promote?
Oh, you do? You don't? You see that I ignore you?
I'm taking score.
Would you like to promote your newsletter?
People should read it. It definitely goes in the inbox straight to everybody. But listen, the one thing I would say, when times are good, no one's hiding behind each other as far as reporting on the same day. When times are tougher is when you
Right.
see everybody come out in chorus and tell you, hey, things are bad in this business.
We've gotten such good help over the years from Kenneth Leon. Ken Leon is Equity Research Director at CFRA, and we're thrilled that he could join us right now. Ken, the mystery to me is the duration of these challenges, particularly as James Gorman and his team break out equity, what I'm going to call underperformance collegially. SPACs blew up. I don't think SPACs are coming back. How far out is the equity weakness that we see in the different banks?
Well, I don't think anyone's going to make a bet on the first quarter, but equity will come back. The market will look maybe to the second half, but there's a lot of more here in terms of Morgan Stanley versus Goldman Sachs on who has the right strategy, who builds longer-term shareholder value. And we think it's Morgan Stanley. I think Goldman and David Solomon are under big pressure. They got Investor Day 4 weeks ahead. And the question then is, who does Goldman want to be? Because they're certainly not going to be a consumer bank. They had $1.7 billion operating loss in their platform news segment, including consumer. And if they're going into private equity or asset management, they're going to have to make an acquisition.
I look, Ken, at the acquisition. Great. We talked about this before. Do they grow it organically, or do they look at an acquisition a la Eaton Vance? Is it out there? Is it active? Or is it an index manager?
Scale really matters. And again, James Gorman at Morgan Stanley, he not only got Eaton Vance, but he also got E-Trade, which put him in the top 2 or 3 in workforce 401k against Fidelity. Goldman spent way too much time in consumer bank, and they can get there in getting to. Goldman always wants to be top 3 in league tables, and to do that in private equity or asset management, they're going to have to look beyond organic. That puts a lot of pressure on David Solomon to drive shareholder value. No one really cares about fixed income trading in the fourth quarter, and the market never gives you a higher multiple for trading. And then you're left with an agent business as the best investment banker, but you're still not going to get the multiple of a BlackRock or a Charles Schwab.
John, let's call it the Leon urgency right now. I'm looking back to the great financial crisis, and Morgan Stanley and Goldman Sachs really intertwined. Something happened at the bottom of the pandemic. Goldman Sachs up 165%. Morgan Stanley up 243%. The Gorman Delta.
So, Ken, let's talk about valuations. Relatively speaking, it appears to me that you think Morgan Stanley should have a premium over Goldman. That's the relative story. Can you talk about the absolute story for the whole sector, going into what people anticipate will be an economic downturn potentially this year? Ken, how do you think they should be valued?
So we at CFRA think financials could outperform this year and outperform the S&P 500. Also, there's other areas of the financial sector like insurance that did well last year. You need the banks. You need both the large and the regional banks to outperform. And if we have a Goldilocks economy with net interest income rising and stable loans, that's pretty good. When you get to investment banks, you need a risk-on versus a risk-off environment. And to my point before, we're not going to be there in the first quarter, but all of a sudden, those stocks can take off, but we just don't see it near term.
So, Ken, there's 2 ways of explaining this. One is that a call on the economy. that you avoid the economic downturn. The other is a call on the quality of the institutions, the defensive nature, perhaps, of some of those names over the last 10 years. Ken, do you subscribe to that theory that these names are higher quality, more defensive, less cyclical almost for some of them?
They are. So even if we were sitting here in 2010, 15, or 2019, the banks are in a great position, but we can tend to bend over to the more traditional banks of JP Morgan, Chase, and also Bank of America. And we still think it's a little bit too early on Morgan Stanley and Goldman Sachs. I really want to hear what their strategy is, because that's the only way that they're going to drive shareholder value.
Ken, thank you. Ken Leon there of CFRA. And Ken, thanks for everything over the last couple of days as well, with us on Friday, breaking down the bank numbers. Schneider, just briefly, what time are the calls? Goldman, Morgan Stanley. When should we be following the headlines from them?
From 8:30 onward, keep following it. I would also say whatever they say about headcount and compensation will be important. You are seeing headcount up 10% over at Goldman ahead of those cuts. You are also seeing Morgan Stanley saying compensation is decreasing despite higher headcount. So,
wow. Okay, so you've got
more
Goldman
people, less
headcount
money.
up 10% just before they're about to cut by what, 10%?
7. So net, your headcount is still rising on Wall Street. You're just getting paid less for
What
it.
do you make of that, Tom? Just those numbers on hiring, on the labour force, Morgan Stanley, Goldman.
My answers go of all this, of the last 3-4 days of banking ballet. Everybody's got a plan. Everybody's moving forward. Moynihan, all the rest of them. Goldman Sachs is at a different point, and I'm with Mr. Leon that the urgency here. I've said that. I don't think anybody's surprised that I'm saying this.
Schneider, brilliant work over the last couple of days. Thank you. We'll catch up with you in the 9 o'clock hour a little bit later this morning off the back of these numbers. Goldman right now down by about 2.3% in the pre-market. We have a plan for the next hour. Neil Dutter, the head of US economic research at Renmac, Renaissance Macro Research, is going to join us. Is that in the studio, Tom? I hope it is.
I hope so.
Neil Dutter coming up in
he's
about
nearby
50
here.
minutes.
He was going to come to Davos to see us, but he said, if you're in New York, I'll come to New York.
He was there in New York.
Yeah.
Did he miss the flight too?
He missed the flight.
He missed the flight.
Yeah.
That's what happened when you ordered that extra round at Newark. No? That's what happens. Flights get missed. This is what happens, Tom.
Yeah, it happens, and they tried to get me there. They gave me the car from one plane. You come down the plane.
Oh, like
and you
the
take
fancy
the little
service?
car.
The fancy service, yeah.
Even with that, I couldn't make it.
Couldn't get there?
Well, I travel with 6 suitcases, so that was
you
the
have
problem.
those metal ones with stickers on. I've seen it.
Yeah.
What a scene.
The luggage was
Got
just
to update
too
you,
much.
Tom, to something a little bit lighter.
I cut back. I used to take 7-8 suitcases to Davos, and the walk up the mountain from the train station is so bad.
Was anything in them, or did you just like to be seen?
No, I'd take them to bring swag back and, things for
like
vet
free
bill and
stuff.
Free stuff.
Goodie bags.
The free stuff's great. The box of chocolates that you get is, Dr. Schwab sends you a box of chocolates.
Yeah.
Pretty good.
I remember the Bloomberg Davos chocolate. That was pretty good.
Yes,
Those
it was.
special bars we'd
Those
make
are
up.
milk chocolate. Yes.
Nice. Okay. Neil's coming up in about 50 minutes. Look out for that. Equity futures right now down about 0.2%. And I heard a rumour that maybe we'll catch up with Bramo next. There's been a Lisa sighting, Tom.
Oh, that's okay. Let me do the check. She's up at the crack of 2 p.m. Wonderful.
Good for her.
Yeah.
From New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Russia wants to boost the size of its military to 1.5 million personnel and create new command areas near Europe. The Kremlin says that's in response to what it calls a proxy war being fought by the US and its allies in Ukraine. Russia's military currently has a target level of more than 1.1 million personnel. For the first time in 6 decades, China's population is shrinking. It's the latest milestone in a worsening demographic crisis for the world's second largest economy. Government data says that at the end of last year, China had over 1.4 billion people. That's 850,000 fewer than the year before. The number of births was the lowest since at least 1950. A new report says that international trade will grow more slowly than the global economy over the next decade. According to the Boston consultancy group, the war in Ukraine will reshape strategic alliances and alter the flow of cross-border commerce. The report forecasts that trade will grow at an average of 2.3% through 2031. Emerson Electric has gone public with its pursuit of National Instruments. It's revealed a roughly $7 billion bid to take over the maker of measurement systems. Emerson made a cash offer of $53 a share in November. Now that's an improvement over a proposal of $48 it made back in May. Emerson says National Instruments has refused to work it over the past 8 months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Inflation will eventually come down, maybe just to 2.5%, not to 2%, but interest rates are not going to come down to the same level as they were before. They're not going to come down to the same level as we saw. I wouldn't be surprised to have, say, a Fed funds rate of 3.5 quite a while from now.
Ken Rogoff there, the Harvard professor and former IMF chief economist, sitting down with Bloomberg's Lisa Abramowicz a little bit earlier. We're going to catch up with Bramo in just a second. Equity futures right now are negative by about 1/3% on the S&P 500. Softer, lighter negative to kick off the trading week. For those of you who enjoyed a long weekend stateside, welcome back. In the bond market, yields are higher, Tom, by 4 basis points. Your 10-year 354.76, and crude, there it is, TK, sticking with an 80 handle on WTI.
To me, it's the unspoken story. You've singled out the stock market move, John, that we see the VIX 20.15. And I'm sorry, West Texas now nicely above 80, and Brent crude rounded up with a vector up $86 a barrel, and Brent crude oil is moving.
We got some China data overnight, and to be honest with you, Tom, I think that data could have said absolutely anything, and this market and investors would have looked right the way through it, looked past it and said things are going to get better by the end of the year.
It's the will of the government. Enda Curran talked about that, the pressures that President Xi in Beijing are under, and he made very clear, both on-air folks and off-air, that, Enda talking about Hong Kong opening. I've got some family conversations over there talking about back to normal. Are they at normal? I'm not sure. We don't have that knowledge, but we can say within the heartache of COVID, real issues with their old people, unvaccinated, there is an effort to get back
That's
to
the
normal.
message they want to sell in Davos, Switzerland this morning, that's for sure. We heard from the Vice Premier a little bit earlier who said China is back to normal. Tom, you can decide whether you think it is or not, and I'm sure the people within that country will make that call for themselves.
Well, we'll have to see. I think one more thought here, John, on China, which is they're as data dependent as we are. We've got retail sales coming up later this week, and then on to the February 1 Fed meeting. It's a different world over there, but it's no different. To me, the big number here is Japan's CPI. The Bloomberg Terminal, folks, is a 4% statistic on Japan inflation. John, that's like the Netherlands, 11, 12%.
Look, I think the BOJ decision's fascinating. What's fascinating is all 43 economists surveyed by Bloomberg, except one, expect no change.
Right.
Except market participants are really focused on what happens, and I think we get some forecasts from the BOJ as well, Tom, alongside that decision.
Right now, Lisa Abramowicz is at the meetings in the World Economic Forum in Davos, Switzerland, and joins us now after doing what you do, which is you talk to somebody with legitimate academic and engineering competence on the auto business. George Berzer is with Mercedes, and Lisa visited Mercedes to talk to the guy totally up to speed on gas, EV, and hybrid. Lisa, what did you learn?
Well, Tom, you guys were framing it really well about how people want to believe China is going to reopen, the optimism that people are looking for at Davos. And before I came here, I wanted to visit someplace on the ground that was dealing with some of these 30,000-foot issues that everyone's talking about here, supply chain disruptions, the energy crisis, and potential geopolitical risks. Read China's reopening and what that means. Someone who's dealing with that in a more concrete way, Jörg Berzer, deals with that, with having to head supply chains, head production for Mercedes-Benz. Take a listen to what he had to say.
We're in the middle of one of the biggest and most important transformations of an industry. We decided 3 years ago to invest more than $1 billion in our US operations. And obviously now we're scaling up electromobility production. I think we will still have an interesting situation on the supply chain. Semiconductors is not over. One of our biggest but also most interesting challenges is the ramp up of electromobility. What we learned now in the last weeks also out of China, we mastered the challenge. So this fast decision making, a lot of creativity, a lot of trust in the local team. China is a very, very important market for us. What we are really focusing on is to create the most efficient and the most resilient supply chain.
What was clear to me from the conversation with Jörg Burzer was that China is such an important market for Germany, for a lot of the world. And so, yes, a lot of the potential optimism is hinging on the reopening there, and people want to believe in that. But also, that decoupling isn't happening as quickly as people think, because a lot of nations, Germany in particular, really relies on trade with China for a lot of the economic momentum.
Lisa, how has Mercedes adapted to the small issue of a war in Ukraine?
They've been really focused on diversifying their energy sources. They've got a solar plant on the ceiling. They deal with wind power. They have a whole host of batteries, old batteries, electric batteries from cars that they use to power parts of their operations. They're trying to insulate themselves that way. But this has been a huge issue, right? And that was one underpinning the conversation. Mercedes thinks that the world is going to be mostly electric with respect to EVs by 2030, and this will accelerate that. On the flip side, I was saying to him, what about all these people who are investing in fossil fuels right now and are sort of ignoring what's going on? And he said, no, this is really what's going to be there. Also, I just want to say there were robots everywhere. There were little robots, there were big robots. One of them almost ran me over. And it was interesting to me how much they're investing in some of the technology to replace menial labor, basically to make things more efficient. And they said it's about 20 to 25% more efficient. And they said that all of their colleagues are doing the same thing. To me, this is really interesting, that level of investment that's going to be happening that could potentially transform certain parts of certain industrial complexes.
Hey, Lisa, you mentioned EVs. Let's talk about the elephant in the room. The news last week, 20% price cut at Tesla for some vehicles across Europe and across the United States as well. Bramo, how are the likes of Mercedes going to respond to that?
Well, they also recently announced a slight price cut over in China. There is an issue of trying to corner the market, and it's which market are you cornering? Tesla perhaps is competing with perhaps slightly different types of competitors than Mercedes, which is a luxury vehicle. But you're right, there is this price competition, and I think that what you could feel in the conversations that I had with everyone there was a bit of a test. We've never been here before with prices moving up so quickly that people are able to basically throw out their price and see whether people are willing to take it. So there's a question of whether this is a lack of demand or whether this is getting too greedy, of whether this is looking for profit margins that are too fat. And I don't know the answer to that. And I don't know that they do either. But it does seem like there still is quite a bit of demand globally for electric vehicles, or at least that's what they're putting out there.
They've had a tough time of it, that's for sure, in the last 12 months. Having a good time of it. Chevron, you're going to catch up with Mike Wirth a little bit later, Lisa, I think in about an hour from now. What's the focus of that?
I want to know about when they expect to see China's demand come online, given the fact that everyone's talking about how this is going to generate growth. We've been talking extensively, I know you and Tom talking a lot about when this causes prices of oil to rise. We're seeing a little bit of that. How much more do they see that coming down the pike? Where are they changing some of their drilling and exploration in response to geopolitical risks? Have they rejiggered some of that? And also, are they investing more in fossil fuels? Are their investors allowing that and actually rewarding them more for making investments that a couple of years ago they would have kind of shunned because of ESG concerns? I'm curious about that sea change and how they're responding to it.
Looking forward to the conversation. Lisa, great work, as always, and looking forward to the week ahead with you as well. Lisa Abramowicz there, the World Economic Forum in Davos, Switzerland, Tom. Mike Wirth of Chevron coming up in about an hour from now.
The engineer from Boulder. And I know it well. He was about 8 years behind me there. And all I can tell you is his biggest headache is how to compete with other big oil and how to... It's so bad, John. It's not how to deploy capital. The real focus is a type 2, how to not screw it up. It's amazingly serious about how not to buy Siberian oil fields that go wrong 12 years later.
And make some big mistakes.
Yeah,
I
Chevron,
could mention a certain British company that may have done that.
Exactly. Sure. You're way ahead of me on this. But the bottom line is all of these guys are a generation behind massive misdeployment of capital. And that's really where his head is.
And that's conditioned them. That's conditioned them, and that's why we've had the rally the last couple of years in energy, right?
Yeah.
They were bruised. They were battered off the back of overinvesting.
Can I bring up something I think is really important?
You don't need my permission. What are you looking at?
You know, I mean, I went back and forth with Francine Lacroix this weekend. She has just written with Lucia Giftopoulou a brilliant story on what matters with Lawrence Fink. We're making fun of the Davos jabber. And Larry Fink, talking with Francine Lacroix, talked about what I think is his third rail right now, which is ESG is blown up. It's probably good that I'm not in Davos because my questions would be brutal on this. ESG has been run over by the war in Ukraine and by the dynamics we've seen among, and I say this somewhat in spoof, King Cole. And Larry Fink saying that ESG narrative, it's become ugly and it's become personal as people go after him.
How active do we want a passive shop to be?
Well, this is his public policy.
Isn't that an important question to ask?
I am fascinated by what the next or the new ESG looks like. I really am curious about that.
I mean, I think that
Francine killed it.
The branding now is just absolutely toxic, isn't it? Don't we just have to totally just drop
it's a
the branding?
toxic brew. Where'd we learn that? Grandma, we miss you.
The market is kind of in a very lofty state at this point in time. You're seeing a lot of irrational trading.
The Fed focuses on the level of inflation, but we in markets, we focus on the direction of travel and saying, hey, it's going down, so maybe I should be buying stocks.
In terms of the inflation, we continue to see the Fed working and bringing it down.
US inflation's now decelerating.
We're probably in for another few rate hikes. That all signals a significant slowing in demand and even also a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We welcome all of you. Our studios in New York on radio and television. Bramo at the meetings of the World Economic Forum in Davos. She'll be there with Michael Wirth of Chevron. Look for that here in a bit. Right now, John, we are resetting, as you mentioned earlier, for the shock of 9 days. Better than good than the gloom crowd of December 29th.
Well, what a rally, and how the narrative changes off the back of a rally, hey? I've said it a few times this morning, what a difference a rally makes. Euro stocks 50 before today, up almost 10% year to date. EM equities up about 8% year to date before today. Mentioned a couple of single names. LVMH, Tom, flying by about 16 percentage points year to date. Luxury doing better than good. Copper prices, take your pick right now. High yield, credit, United States, tighter.
I like how you link copper into LVMH and luxury, and this is about the China reopening. And I would suggest the China reopening is not a brilliant score by people that predicted that or an own goal by those that were looking against it. I would suggest China's about shock. It's about the total unpredictable shock that can happen.
It clearly is a massive change. And when you start to get a reopening like the one we've got in China, people will be a lot more tolerant of weak data coming out of that country. It wouldn't have mattered what the data was overnight. And the data, I'm told, was better than estimated. Whatever that means in China, when they can basically tell you whatever they want to tell you about Chinese economic data, people appreciate the idea that things are going to improve. And things are better now than they were a few months ago. And the fact that you can see call after call, not just out of China, but also in Europe.
Yes.
Goldman coming out last week and saying Europe can escape recession. Deutsche Bank into the weekend saying Germany can escape recession. That's why we're seeing this massive move that we've seen in some of the European names. That's why we're seeing some of the big moves we've seen in copper and the luxury names as well. And it's spilled over to the US. And this is what's interesting to me, Tom, that we've got high yield spreads in America.
Coming in, Bramo identified that. Yeah.
Tighter at a time where people are still talking
She's
about recession.
She's only worked like 2 days this year, right? I mean, she was on vacation.
She went skiing.
Traveling. And
now she's doing the work, the hard work.
The hard work, the hard lifting.
The heavy lifting.
You know.
I'm excited about that interview later this hour, Mike Wirth, Chevron.
Yeah, it'll be interesting to see. And well, let's go to the three stories of the morning. Let's start with Mr. Wirth, and that is rounded up Brent crude, $86 a barrel, and Jeff Curry and others speaking about that. Is this the path to $100 a barrel?
WTI, $80.20. Goldman calling it a bullish concoction.
Right.
A bullish concoction. If you want the full quote, you cannot come up with a more bullish concoction for commodities. A lack of supply is apparent in every single market you look at, whether it is inventories at critical operating levels or production capacity that's been exhausted.
Japan not
Strong
being
start.
discussed at Davos, this is a week for Japan to decide.
On the BOJ?
Yeah.
Do they drop yield curve
Huge,
control?
huge deal.
Do they take another step?
Yeah.
What kind of policy is Governor Kuroda going to hand over to the individual that takes over from him in April?
Retail sales, let's finish with that before we move on to the data. Retail sales, to me, John, huge mystery, underplayed, and frankly, is 70% of GDP. We should really focus on that.
So hard data good, soft data bad. Survey data, the ISM data has not been pretty at all. So there's kind of a little bit of a gap opening up between what's happening and what we're told is happening. So
Right.
the labour market data good, you look at payroll solid, retail sales, we'll see what that says. Then the survey data is looking ugly. ISM's sub 50, manufacturing services.
Yeah.
Yet markets are doing well in the face of that. So something's got to give.
And the thing that I saw here to finish this up was Goldman Sachs, the urgency that Shonali Bassick showed, where coming out of earnings season, the pressures on the Goldman Sachs management to right size and move forward are greater than I thought. I misjudged that.
So we put two things together then. Layoffs at Goldman. We've talked about that over the
Big
last
ones.
few weeks.
The character of them,
Layoffs
yeah.
off elsewhere as well. Bonus pool. Did you hear about the bonus pool being cut left, right, and centre?
Yeah.
And at the same time, the research divisions of many of these banks now indicating that we can escape recession, that perhaps we can have a soft landing. So you've got corporate leadership getting defensive and conservative
I
about what
agree
may or
with
may
that.
not materialise. And at the same time, you've got people trading this stuff who are saying perhaps it can be better.
And an earnings season forward, as we see that, as you mentioned, in the big tech companies as well. I'm going to start, John, 210 spread, negative 68 beeps.
Equity futures right now, negative 0.4%, Tom. Yield's just a little bit higher. Some steepening, Tom, this morning, up 6 or 7 basis points on a 10-year, 356.98 euro dollar. Bit of strength coming through now, 108.52 on euro dollar. We heard from Mr. Philip Lane speaking to the FT, the chief economist over at the ECB. More rate hikes still to come. The ECB's next decision is February 2nd, the day after the Fed.
Right now, we're going to recalibrate to something we don't do enough on, which is actually on allocation of portfolios, on the decision to change things. Everybody looking at that now after the death of 60/40 last year. Marta Norton is excellent at this, as CIO of Americas at Morningstar. We're thrilled she could join us this morning. Marta, is there value to rebalancing? Morningstar's lodestone is page after page of data excellence on funds to make a rebalanced decision. After the carnage of 2022, should you do more or less rebalancing?
Good morning, Tom. You're raising that point of the 60/40, and no question, in 2022, I think we got to see the 60/40 finally through a three-way mirror, so to speak. We can see it a little bit more clearly. We can see its strength certainly over the decade prior, where it was just ascendant, and then over the past year, we saw some of the correlation that exists within the 60/40, maybe not the protection that we would have thought. And no question that as you see big price moves, it calls to question whether you should rebalance back to target. And the real value of that, of course, is that you're taking advantage of price movement in your favor. So you're adding to the things that have sold off, you're trimming the few things potentially in your portfolio that have rallied, and it just gives you an opportunity to put valuation on your side.
What is the update on the concept of target funds? They were trotted out 10 years ago, and I'm going to give Morningstar great credit on this for not selling them to the public like most of the firms did. But there was this whole contrived thing of gaming out 10 years or gaming out 15 years of that. We had the great financial crisis and then the small matter of a pandemic. Do target funds work now for allocations to retirement?
I think the general idea, and this comes back to, just your broad stock bond mix, the general idea that a simplistic allocation between stocks and bonds based on, kind of maybe your time horizon, that can be a really powerful tool, especially when markets are moving in your favor. But when you have surprises that challenge the fundamentals, and maybe we're seeing, some sort of regime shift, when we see the pressures from inflation, the pressures from interest rates, I think it's worth remembering that there's still, an importance to having a smart fundamental understanding of what you're owning and how it should be complementing and diversifying one another. Now, I think, the death of 60/40 asset allocation, simplistic asset allocation, I think there's a lot of people doing victory laps around the difficulty difficulties that had in 2022. And I think it's a little early to say that it's an ineffective strategy, but no question that we have to understand that there are weaknesses to every strategy, and there's weaknesses to a simplistic approach as well.
I want to pick up on a phrase you just used, Marta, and thanks for being with us on the programme. You said think about how they complement one another. Can we do that just a little bit right now? Is there any reason to believe that the correlation between bonds and equities is going to break down and return to what I think is a little bit more intuitive for a lot more people out there?
You know, I think it's a really critical question. And when we look at time series of correlation between, treasuries and equities, I think we always assume that it's baseline a negative correlation. But actually, over time, it can vary quite a bit. And I think when inflation and interest rates are the market's focus, that's when we're going to start to see a positive correlation in a negative sense. That's what we saw in 2022. I will remind everyone that we saw a lot of positive correlation over the past decade between the two, and no one was all that concerned about it because they were all moving in the right direction.
Exactly.
But I think should we start to see a recession come into the fore where that's the critical concern, that's where I think you can start to see some dispersion between how fixed income treasuries might behave and what you might expect from your equity portfolio.
It's great when they're both going up, Marta. You know that. It's good to catch up. Thanks for being with us. Marta Norton there of Morningstar. Tom, it's true what Marta just said. When equities were up and yields were lower and bonds were rallying, there weren't many complaints out there about that correlation between bonds and equities, were there?
Yeah, and I'm a huge user of Morningstar, and I think Morningstar has been misused over the years. Everybody's looking at it as a panacea, sort of like what my brain isn't working right now, but the basic idea here is it's simplistic to look at it as 5 stars or 4 stars, and the answer is it was easy there for 15 years or even longer. You could almost say. All of a sudden, as Taleb says, the gravity's back. I have very strong personal opinions about rebalancing. Nobody cares what I think about it, but the bottom line is allocation concepts now are way more serious than they were 3 years ago or 5 years ago.
I think to the point that you're both making, the 60-40 simplistic kind of focus on that thing, that it works for everyone. 60-40 is not great for everyone at different times of their life. As you know, if you and I sat down with a wealth advisor, I think they'd have different conversations with us both, Tom, based on where we are in life and what we want out of life and how much risk we want to assume and what we want to do with that portfolio.
Don't get me going, John. Where's the surveillance court?
I'm just taking little jabs. Lisa, you're not coming with me.
I just... I could get in trouble here.
You don't fancy it?
I think it's marketing BS, is clear as I can make it.
How much of that, so this is an important conversation for a lot of people listening, how much of that marketing, you said BS, are we going to hear this year when asset managers are lining up, trying to attract capital to go into bond funds because they believe that bonds are back?
I'm going to go Ritholtz 101 on you. If you are modeling retirement off 6-month strategy, you have a license to fail. Ritholtz 101, and Barry's correct.
Neil Dudder's going to join us in just a little bit. He joined us from Renmac. Looking forward to that conversation on why he thinks this economy is doing better than good, at least for now. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. In China, the economy proved more resilient than analysts forecast. Last year's GDP growth of 3% was the second slowest since the 70s. Still, data from the fourth quarter and December came in better than what economists had expected, and that's despite a COVID outbreak that suggests the worst of the slump may be over. Meanwhile, trade between China and the US is on track to break records. US government data through November suggests that imports and exports in 2022 will add up to an all-time high. The final report is out next month. Here in the UK, teachers are joining other workers who have gone on strike in their fight for higher pay. The teachers' union says members in England and Wales voted overwhelmingly in favour of industrial action. Meanwhile, nurses plan to stage another walkout next month. Tesla CEO Elon Musk will be the star witness at a jury trial trial that starts today in San Francisco. The issue, his infamous tweets in 2018 about a plan to take the electric car maker private. Quote, funding secured. Lawyers for shareholders argue that Musk lied in the statement and that it caused them losses from wild stock price swings. And Emerson Electric has gone public with its pursuit of National Instruments. It's revealed a roughly $7 billion bid to take over the maker of measurement systems. Emerson made a cash offer of $53 a share in November, an improvement over a proposal of $48 it made back in May. Emerson says National Instruments has refused to work with it over the past 8 months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
We're already falling behind. We've said this before. We need today to invest just to keep production at current levels, let alone cater for additional demand, which we see rising by at least 10 million barrels a day by 2045.
That's the view of the OPEC Secretary General a little bit earlier this morning. Live from New York City, good morning to you. Equity futures look like this on the S&P, down 1/3% on the S&P 500, coming off the back of a 4-day winning streak on the S&P. Can that continue? Tom, very focused on crude, as am I. $80 on WTI, 85 on Brent. Here's the latest from an OPEC report. Grant Smith writing this one up for us at Bloomberg. OPEC expecting global oil supply and demand to be imbalanced in the first quarter as top official from OPEC saying he's, quote, cautiously optimistic on the economic outlook. The OPEC countries will need to provide an average of 28.85 million barrels a day in the first 3 months of the year, roughly 120,000 barrels a day less than it pumped last month, Tom. Just the latest numbers from that report from the Organisation of Petroleum Exporting Countries.
The operative word is unched. There's a lot of unched in the report, but I see some things, John, that are not unched, and one is China growth. I believe they model in 3.1% China growth, and that is far below what we're hearing from some street observers, and I really wonder what that dynamic will be.
Well, that's the bottom line. For the year as a whole, OPEC predicting that world oil demand will increase by 2.2 million barrels a day to average 101.77 million a day, while supplies outside of the group will expand by 1.5 million barrels a day. And to your point, Tom, China clicking back in, we're going to see what kind of damage that inflicts, or rather, what kind of rally that fuels in the commodity market.
And you look at a gallon of gas in the United States, Lisa and I always click on the same one. I got $3.32. I know there's many other prices out there as well, John, and I'm sorry, I'm going to take it back to the pandemic, and up we go, $2. Remember $2 a gallon?
Oh my goodness, remember negative prices?
Remember $5 a gallon? And we're down to $3.32, which is sort of, mid-level 2021
Where are we
level.
on refilling the SPR now? With
I don't
clicking back in at 80.
I agree. But then I have trouble with that because I'm not an expert on it. I listen to the experts on that, and they're sort of mystified by what we did.
Let's talk to one right now about it.
We could. Let's rip up the script. We can do that with Julian Lee, Bloomberg Oil Strategist. Julian from London, and with all your, we'll get to supply and demand and all that in a moment. But you're an adult on this, an academic elite. Brief us on why the SPR discussion in America matters.
I think it matters because we've become very, very used to having this huge inventory of oil in the ground that can be called on at very short notice to meet any supply disruptions. Now, I think it's important to bear in mind that, the SPR and the size of the SPR really dates back to the 1970s, when the US was a huge importer of both crude oil and refined products. That has changed dramatically. And in order to meet the import needs of the United States now, you actually need far less oil in the Strategic Petroleum Reserve than you did 10 or 20 or even 50 years ago. So I personally think that some of this agonizing over rebuilding the SPR to historic levels is somewhat misplaced. yes, an awful lot has been taken out of it, and some of that over time needs to be put back in again. But I don't think it's quite as urgent as perhaps some people are arguing.
I want to go back to your work at the Center for Global Energy Studies, Dr. Lee. And basic idea here is guessing supply and demand, as we just saw OPEC and OECD and IEA and all the rest of them do it. Tell me about the certitude of guessing oil demand. Can you guys actually calculate it?
I don't think anybody can really calculate it. I mean, a lot of the estimates are based off people's forecasts for economic growth and for population, and you know, models have been developed over time that have matched the growth in gasoline demand or any sort of oil demand reasonably well. But if you then sort of start looking at these forecasts, and more importantly, looking at the revisions that are made to estimates, not even of future demand, but estimates of historic demand, we see that those agencies that care about what happened in the past are revising their demand numbers often as far back as 5 years or more. And that to me says that, yes, you can get a pretty good broad picture of the direction that demand for various oil products or even total oil products is going. But pinpointing the actual number, I think, is a mug's game.
Julian, can I share this quote from Jeff Curry with you, which I'm sure you've read already, but for our audience who may not have seen this just yet. Jeff Curry, who runs commodity research over at Goldman, had this to say in a presentation. You cannot come up with a more bullish concoction for commodities. Lack of supply is apparent in every single market you look at, whether it is inventories at critical operating levels or production capacity exhausted. I think there's been some pushback this morning, Julian, over this line. Lack of supply is apparent in every single market you look at. Is that true of crude?
I don't think it is. I mean, I think we've got, you know, there's certainly a spare capacity for production within the OPEC countries. Saudi Arabia certainly has spare capacity. The United Arab Emirates certainly has spare production capacity. Nigeria, which has been languishing for much of 2022, started to successfully increase its production in December, getting to grips with some of the issues that have kept a proportion of its supply off the market. So there is a degree of spare capacity there. What I think is concerning people about oil supply in 2023 is what's going to happen to Russia. How big a hit is there going to be to Russian production from sanctions? There hasn't been much of one once so far, but I noticed that OPEC is forecasting that Russian production will drop by, I think it was 850,000 barrels a day this year compared with last. Others see a slightly bigger drop of 1 million barrels a day or maybe a little bit more. So there's certainly that concern. There's certainly a lot of countries in the world where perhaps production looks a little bit fragile given political situations. Libya is perhaps a case in point. And there is this long-running, and this is really a long-running underlying problem that people keep highlighting about a lack of investment in new capacity. That has been, I think, hidden for a number of years by the US shale boom. But if you strip that out, the investment in sort of conventional oil fields has been low for years. And OPEC keeps arguing that this is a problem, and they're not wrong. But that investment does trickle through, and the places with the cheapest reserves to develop are largely the OPEC countries themselves.
Julian Lee, thank you, sir. This was fantastic. Julian Lee there of Bloomberg weighing in on the commodity story off the back of the latest OPEC report and a pretty bullish outlook coming from Goldman Sachs. Here's the outlook for the next hour on Bloomberg TV. Coming up on the Open, Gershon Distenfeld of AllianceBernstein, Troy Gajewski of FS Investments, Stephen Chubak of Wolf Research on the latest bank earnings, and Chanel Desai of Franklin Templeton. I've got to say, Chanel Desai, Tom, is pretty punchy about the idea we're getting way too comfortable with this call that inflation declines quicker than people are anticipating.
And where to? And Professor Rogoff touched on this as well with Lisa Abramowicz in Davos. Is like, where are we heading towards? And the idea that we're going to 2 and even a quiescence of 3, I think, is possibly off the mark. I just want to point out that the most expensive glass of wine I've ever held in my hands in my life Skybridge was Troy Gajewski
at the Skybridge party.
At the Skybridge wine party. And I
what was it? Do you remember what it was?
It was red. I mean, it wasn't Boone's Farm.
You're not a wine man.
Oh, I'm not
clearly.
a wine man. Oh no. When you're weaned on Utica Club and Jenny beer, you're not a wine connoisseur. But Troy Gajewski, you bring it up with him, he absolutely nails the fancy, and he can sit there and do the whole, on radio I'm doing the sniffy thing.
You still haven't bought me a Jenny Cream Ale.
Oh, it's a rare breed. I mean, you have to.
I'm off the drink this year.
Oh, are you?
Yeah, totally.
So am I.
Totally, I'm done. You along for the ride?
Yeah,
okay.
More or less.
Just helps with the aging process, apparently, Tom.
Yeah,
Live longer, all that stuff.
I'm pickled. Bloomberg Surveillance, our studios in New York. Good morning, Lisa Abramowicz with the World Economic Forum in Davos. We'll get to her here in a bit. John Ferro getting ready for the 9 a.m. hour. That is a good and beautiful thing. And right now, it's a tertiary statistic, but right now, we're so desperate, we're looking at everything we can. It's going to be most interesting to see from Buffalo, New York, the Empire Manufacturing Index. We really never covered this. And then McKee said, shut up and cover it. Good morning.
In this case, I think we may have a bit of a reaction on Wall Street because it's an absolute collapse in the manufacturing index for New York. It falls to negative 32.9 from negative 11.2. That is the lowest since the depths of the pandemic, and it is the second lowest in history for this index, which goes back to about 2000, 2001. New orders fall from negative 3.6 to negative 31.1. And employment falls from 14 to 2.8. So very bad news on the production side. The only good news you could see in this report is that prices paid also plunge from 50.5 to 33.0. So maybe what you're seeing here is the result of the Fed and its tightening policies, and you could spin this as good news.
Come on, Mike.
I see your next guest laughing at me over there. But if you're looking for a story, it could either be things look terrible for New York manufacturing or things look better for inflation overall.
The Broncos probably wish they were in Buffalo the weekend of December, week 11 or whatever, when the Bills, I think, had to move their game to Detroit because it was so cold. You can't tell me this isn't weather adjusted for 30 days after the cold Western New York and frankly all of New York. Remember that, Mike?
Yeah.
Were you here for that, or were
but
you?
But this is a January number, and that was a
so
December.
This doesn't include
this
the cold.
does not include that big snowstorm in Buffalo. However, we should mention, you were right, this is considered something of a tertiary index, and it doesn't necessarily follow through to other regional PMI indexes. However, it is something on this Tuesday morning that gets your attention. It's the only number out today, so it does get somebody's attention.
20 seconds, retail sales coming up on Thursday. Your look at it.
Well, we're expecting a drop in retail
Control
sales.
group and all that comes down.
And all that comes down, which you would normally expect in January, although it's seasonally adjusted. But it does look like maybe Americans pulled back somewhat.
But it's not inflation adjusted. So if inflation comes down, retail sales come down, right? That's a theory?
That's a theory. And inflation's come down, but not all that much. We're still, on a year-over-year basis, still fairly high. And in the last couple of CPIs, apparel prices have gone up.
Okay, Michael McKee, thank you so much. It'll be an eventful week as we go to PPI and retail sales here. I believe that's tomorrow as well. Right now, for Global Wall Street, this is the important conversation for those pushing against the gloom crew. Neil Dutta has absolutely nailed the inability to go to recession, and certainly nailed the market reaction to better than good news with China opening and with a more resilient American economy. With Renaissance Macro, the optimists hang on every word. What is the distinction of your optimism right now? What is the thing that you would describe as the Dada optimism?
Well, I think it's the composition of growth that's improving. I was going to say, Mike, one reason why the Empire number is coming in, maybe they surveyed people before the Giants win against the Vikings. I mean, that could be what's going on. But, Tom, I think the composition of growth is improving, right? So even though inflation is moderating, real economic growth is accelerating. And I think that combination of growth is the sort of challenge for markets to kind of deal with.
Let's dovetail your comments with Ken Rogoff, with Lisa Abramowicz in Davos. And this is the idea of disinflation. And even if we're having this parlor game of where it moves, you put out a blistering chart, I'll say 8 days ago, that said, wait a minute, if you get disinflation and incomes do okay, real incomes can stabilize, or dare I say, inflation-adjusted incomes could actually go up?
Well, they're accelerating right now. Real incomes net of transfer payments are accelerating. I mean, that's not even a debatable point. As an example, in December, we know that aggregate wages and salaries probably rose around 2 to 3/10, and we know that headline inflation fell. So that means that real incomes rose. And then you have to basically make the assumption, what do people go out and do with the newfound income? And, my sense is that they probably spend it. Financial conditions have been easing. I don't think you can really make much of a case right now that people are going to just spontaneously increase their rates of savings. So that should keep firm underbelly to consumer spending. And we know that housing is now picking up again. So.
At Davos, I wouldn't do algebra, but since we're in New York, we're going to go algebra Tuesday here. Y equals C plus I plus G plus NX. And all of a sudden to me, NX is a constructive mystery with China reopening. Does China reopening and export-import dynamics of America, does that give you more Dada optimism that we could avoid a recession?
Sure. I mean, back in, I think, 2015, then Vice Chair Stanley Fischer did a seminal speech on the impact of dollars on inflation and growth. Remember, at the time, the dollar was strengthening, the Fed was backing off. But now it's kind of working in reverse. And if you look at the broad dollar index, it's off about 10%, I think, since September. And, the dollar has a very mechanical impact on the Fed's kind of workhorse models. And the fact that the dollar is declining, I think that boosts real exports. Maybe 3 to 4% in real terms, and it introduces some upside to core inflation over the next year. So I think the dollar selling off is a sign that global growth expectations are improving, and I think it's an unambiguous positive for the
What is your 2023 GDP number for the United States?
I'll tell you what, it's not, Tom.
Pin this down.
It's not 0.5%. I think that I think something slightly above potential is plausible. Maybe 2. I mean, I think underlying growth right now is around 2.5.
Don't drag McKee into this right now. Help me here with the dots. I mean, help me here with the dispersion of the dots. Are any dots as optimistic as Dada? Is there a Dada dot on the dots?
There's not a Dada dot on the dots right now, which sounds silly to say, rubber baby buggy bumpers. But what you've got going is a situation, and Neil and I actually argued this out on the Bloomberg message system the other day. The Fed makes its forecasts. They make 19 forecasts, and we arbitrarily pick the median and say that's the Fed forecast, and it's made once every 3 months. And Wall Street changes its mind about what growth and unemployment and interest rates are going to be every day, every 5 minutes. And so to go back and say the Fed is wrong by saying 0.5 percentage point growth in December, that's not really fair. The Fed starts to change its mind as well, and they will have a new forecast in March. But even at this upcoming meeting, I suspect you're going to hear Jay Powell say that growth forecasts are rising. And we heard Pat Harker, the Philadelphia Fed president, the other day say he's marked his up to 1% for the year.
Right, but they're taking down let's assume that that's right. They're taking up their growth forecasts as we go into the March FOMC meeting and in February. But at the same time, the market odds of a 25 basis point move are also solidifying. So the idea that they're going to go another 50, that's going down even as they're raising their growth forecast. But look at Bloomberg, though. Look at your own Bloomberg consensus.
I don't know how to do that.
ECFC.
Continue.
ECFC go.
You learn something every day, Tom.
Q1 real GDP, Q over Q, percent change annualized, 0.1%. Q2 coming in at minus 0.6. These are very, very depressed forecasts and this is the consensus, so the one that updates quite frequently. So I think that's dramatically offsides, considering we're going into the year something close to 3, maybe if you trust the Atlanta Fed, 4%. So I think the consensus has a lot of work to do in kind of adjusting their expectations.
Okay, well, in search of it, where is the dot out there? When are we going to see not just a single dot, but go plural, get dots out there from the Fed? When do they migrate? How many meetings out do they migrate where the dispersion lifts up? And there's some real optimism about 1 or 2, even 3, dare I say, 3% GDP.
To me, the dots, the risk with the dots right now is that the cuts that are currently baked into the 2024 outlook get priced out because growth is coming in a lot stronger than expected. So if the Fed, all of these are sort of premised on your assumptions around unemployment and so forth. If the Fed expects the unemployment rate to go up a full percentage point from where it is right now, and if growth is coming in slightly above potential, as I expect, that means that there's room for the unemployment rate to fall. And if the unemployment rate remains low, then the likelihood of them cutting in 2024, I think that goes away. So that, to me, is the risk with the dots.
I can tell you when it happens, Thomas. March 22nd is the Fed meeting at which they will have a new summary of economic projections.
We'll observe dots.
And dots at that point.
Help me with retail sales here. Mike was setting us up for it with his grim empire number. You know where I am on this. I'm like, yeah, okay, whatever. But the answer is retail sales matter, 70% of the economy.
Sure.
Inflation coming in, it's going to be dampened. So how do you interpret retail sales with the dynamic of disinflation?
There's some fluky seasonal. I think if I'm not mistaken, I think December of 2021 was a really weird month. We had a big decline in core retail sales that month, and I think there might be some seasonal adjustment issues that are going on, following the pandemic that kind of depress the numbers like retail sales in December, and we probably make that up in seasonally adjusted terms sometime in the spring. What I can tell you is that it looks like the inventory adjustment is largely over, and so and so I think that could be one reason why prices in things like apparel aren't really collapsing as much as.
Well, this is really important. I'm glad you bring this up. Dana Telsey's been lights out the last time with the Telsey Advisory Group folks on retail. I sort of knew that was going to happen, Mike, but school us on inventories, which is this obscure thing nobody really understands. Don't give me LIFO, FIFO, but are you surprised, like Mr. Dutta mentions here, that we cleared inventories, it seems, really rapidly?
I don't know if I'm surprised because there's no point to a business holding on to inventories it's not going to sell. So if you go to TJ Maxx or Marshalls or something like that, you'll see some of that inventory and it will be marked down because people are just trying to get rid of it because you get new stuff coming in all the time. But also in the retail sales report, we saw in December gasoline prices continue to fall. So that'll take some off of retail sales. Autos they fell, auto sales, they were not as high, but it's a difficult one to translate into the retail sales report.
This is so important, Mike, that we've got people, bring the camera over here, and they're talking on the internet about your socks right now, and the symbolism, these are extraordinary socks, folks. I could never be caught dead using those. What is the economic, are those optimistic socks? Is that what those are?
Well, if it's a donut, it reflects the donut on headline inflation.
Okay, very good. Neil Dutta there with the donut socks, giving us a signal of optimistic economic growth. What we know is Dutta speaks, futures improve, -11 out to -7. The VIX under 20, 19.97. Worth of Chevron with Abramowicz of Bloomberg in Davos. Stay with us.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Russia wants to boost the size of its military to 1.5 million personnel and create new commands near Europe. The Kremlin says that's in response to what it calls a proxy war being fought by the US and its allies in Ukraine. Russia's military currently has a target level of more than 1.1 million personnel. In Venezuela, public sector workers mounted the biggest anti-government protests in years. Workers organized organized at least 50 protests yesterday in Caracas. Teachers were joined by nurses, pensioners and others demanding more money from the government. They have been falling behind in an economy that has embraced the US dollar. A new report says that international trade will grow more slowly than the global economy over the next decade. According to the Boston Consultancy Group, the war in Ukraine will reshape strategic alliances and alter the flow of cross-border commerce. The report forecasts that trade will grow at an average 2.3% through 2031. For the first time in 6 decades, China's population is shrinking. It's the latest milestone in a worsening demographic crisis for the world's second largest economy. Government data says that at the end of last year, China has over 1.4 billion people. That's 850,000 fewer than the year before. The number of births was the lowest since at least 1950. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Bloomberg Surveillance, and we say welcome to all of you from our studios in New York. Tom Keene, John Ferro to be with you in the next hour as well. Futures advanced -11 out to -8. And the VIX has come in a little bit better. I'm going to say quiescent tape within the churn of Tuesday, looking to retail sales as being the key economic number of the day. Let's get right to it. Lisa Abramowicz in Davos. And what Lisa doesn't know is the way you run an oil company is to be sure that you study the mathematics of the legendary Ruth Rebecca Struick at the University of Colorado. I can't tell you, Lisa, how my life changed in Colorado engineering under the hard wooden ruler of Ruth Rebecca Struick. And I know Mike Wirth survived the mathematics of Colorado as well.
Well, from the hard rule that you experienced to the Davos Alps, and what we're talking about here with Mike Wirth of Chevron are a host of geopolitical issues that are coming together with oil front and center. Mike Wirth, CEO of Chevron, so happy to have you with us. But I want to start there. Everyone here is talking about China, the reopening, how much it's going to juice the global economy. When is it going to affect commodity prices in the way people have been predicting?
It could be coming, Lisa. I've met with some people from China even today, and what they tell me is the pandemic has largely moved through the big cities. People are back at work. The economy is beginning to move forward. We're not really seeing it in commodity markets yet, but the absence of that demand is one of the reasons why we've seen prices soften, and the return of that demand is what could start to firm them up again.
Although some people say that China is getting all of their supplies geared up from Australia, from coal, from all sorts of different supplies. They have huge stockpiles that they're going to unleash to dampen any kind of sudden surge in demand. Do you agree with that assessment?
Well, the data out of certain parts of the world is a little bit harder to interpret than others, and China sometimes
That's diplomatic.
is a little bit difficult to see in the short term what's happening. But clearly, in the longer term, we can see that oil demand out of China has been down here during the pandemic, and they will use coal, they'll use liquefied natural gas, but they'll use oil as well. And as their economy does return to full strength, I think we will see it in demand in a world that's pretty tight right now. And so I think that's the case for some upside in commodity prices this year, is a strong return of the Chinese economy.
How much upside could that be?
It's really hard to say. We try not to predict prices because you're always wrong. What I will say is that supply and demand are fairly finely balanced. And post the pandemic, as economies have opened, supply has been struggling to keep up, which is why even before the war began, we saw some strength in prices. And we have markets now that are constrained by rules on who can sell to which countries can buy from other countries, what prices things can transact at. So shipping legs are longer than they were before. There's a lot of strain strain on these markets, and it wouldn't take a big surge from China to really start to push against some of those constraints.
Because of some of those concerns and some of the frictions that you're talking about, have you changed where you do some of your production, where you focus some of Chevron's drilling and exploration?
We really haven't. Those are long-term decisions that we make based on a long-term view on supply, demand, technology. In the short term, we need to be nimble with logistics, with the way that we manage supply relationships with our customers in order to try to be sure that we meet our obligations. So there's a lot of commercial activity and logistics activity to respond to the kinds of things that we're talking about. But the long-term decisions are made on the fundamentals of the geology, the markets, and a long-term view of those things.
Do investors reward you more for investing in production in a way that they hadn't a couple of years ago, simply because of suddenly this renewed focus on fossil fuels after they've been left for dead?
Certainly our sector for the last decade has not performed like the rest of the market. And some of that was, I think, a lack of capital discipline by companies in our sector. Some of it was the narrative that oil and gas were going away sooner than they likely will. And we certainly saw last year the sector performed very strongly. And I do think that investors have reacquainted themselves with the fundamentals of the energy business, with the cash that companies generate in this sector. We've by the end of the third quarter last year, had generated record cash in our business. And so there's more capital discipline. I think the demand is there. And I do think the market is beginning to come back to us. But what I'll say is, earnings in our sector through 3 quarters of 2022 represented 10% of S&P 500 earnings. By market capitalization, it's only 5% of the S&P 500. So I think there's still upside.
Earlier last year, the Biden administration came out and said, we're going to lower prices as gasoline prices surged. We're going to do these releases from the Strategic Petroleum Reserve. Do you think that was a good policy?
I think it certainly provided oil supply to a world that was concerned about the reliability of oil supply. The reserve wasn't really set up for price excursions. It was set up for true supply outages, which we didn't experience last year. So the risk in having used the supplies the way they've been used is if we were to run into something that is more serious in terms of the availability of supply, there's not as much dry powder left as there has been for the last several decades. So it's run things lower. I think it did have a bit of a calming effect on markets. But it's left us in a little bit more of a delicate situation.
And now they're saying that they're going to potentially repurchase at around $70. Perhaps they've missed that, but they might start refilling it come February. Is this the role of the government? I mean, to sort of set a floor? Is that basically what they've done?
It's very interesting, the amount of intervention we've seen governments engage into markets that historically they really have allowed to function on market fundamentals. My personal view is that a price that the government says will refill the SPR at this price doesn't change investment decisions for our company. If we want to sell our barrels in the future at a certain price, we can go to financial markets and do that today. So these kinds of things won't change the way that we invest. I can't speak for other companies in our industry.
Do you think that this could potentially affect pricing next year if there is a push to refill, or that pressure on the other side of supplies coming into the market is not there? I mean, are you expecting that to kind of change the dynamic in a way that the market isn't fully reflecting at this time?
Well, it would certainly be incremental demand in the market that would be buying the commodity, which has been selling it over the last year. My guess is, and I don't have any unique information here, is that the government will refill slowly over time, and that it won't come in a large surge, but in a more measured way that will, probably be something the market can handle.
A lot of people are talking about this renewed focus on fossil fuels and energy companies being their top bet for this year. So suddenly people are absolutely flooding back and saying, perhaps we got carried away with ESG. Have you stopped investing quite as much in some of the renewables? Are you emphasizing that even more as sort of energy security? How are you playing that, given that the dynamic, the conversation has shifted?
Our strategy has been to leverage our strengths to provide lower carbon energy to a growing world. And so we're spending the same money, we're investing in the same technologies, we're working on the same kinds of projects in our new energies business, renewable fuels, hydrogen, carbon capture and storage, technologies like geothermal. Again, we take a long-term view on markets and on investment. And so I think the dialogue being reset, and I wouldn't say it's fully reset, but it had become very polarized. And what I've been arguing for is a more balanced approach that recognizes the importance of affordability, recognizes the importance of reliable supply for national security reasons, and protects the environment, and an approach both from governments and from companies that balances these out. And that's what we've certainly been trying to do.
Just lastly, I'm curious about some of the sanctions that have been put on Russian oil, and some of which are going to come online come next month, particularly around diesel in Europe. How much do you think that's been priced in? How much is that going to be an additional price shock?
Markets are certainly forward-looking. This has been telegraphed for quite some time. And so I think that just as we saw when the oil price cap and the European sanctions came in, the market was generally prepared. I think people anticipate it. The risk is unintended consequences. And products tend to move in smaller quantities to local markets. Not moving a steady source of supply into Europe means that supply will go to more distant markets, and Europe will have to find their supply from new markets. And so I think some of that is underway. More of it is likely to follow. So there is the risk for some disruptions.
Mike Wirth, thank you so much for being with us. Wonderful speaking with you. Tom, back to you.
Lisa, thank you so much. Greatly appreciate that this morning. Churn of the markets right now, and as we speak to Mr. Wirth, the Chevron, $86 on Brent crude, $80.43 West Texas Intermediate. I would point out over the last 10 years, Mr. Wirth, Chevron 9% a year, Exxon 6% a year. There seems to be a Chevron distinction. Please stay with us through the morning on radio. On television, this is Bloomberg. Good morning.